think the technology revolution will continue.
It's just rapid fire movement of money.
The red lights would start flashing if it felt like there was blind euphoria.
We've been on this broadening out theme for a long time.
The market's going to broaden out a little bit.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, volatility returns. Equity futures pushing lower following a volatile session in South Korea as Micron's margins, mega margins, are becoming a mega problem for everybody else. OpenAI is reportedly planning to delay its much anticipated IPO, perhaps into next year.
It's a really messy process that this market is undergoing at the moment, John, because it's trying to find new market leadership. We are so far away, really since May, of Mag 7, that safety blanket of the big tech stocks being able to lead us higher. Now we're trying to decide, okay, is it the infrastructure layer? Is it Micron that's the new leadership? And if Micron is the leadership, is that bad for everybody else? So you're getting these big shifts back and forth between market momentum, and it's leading to a lot of pain in this market.
How sustainable is this? Danny, we're all trying to work out the same thing. Apple attempts to pass on these higher costs, stock down. Microsoft attempts to pass this on, stock down. I've talked about Meta and Microsoft being in a bear market now for a number of weeks. Is that sustainable? Can those guys keep spending that money to benefit these chip players with their stocks getting absolutely hammered?
So much of what these companies have been able to do and their ability to tap the market has been that they've been in an, I don't know if you want to call it bubble, but at least really high prices. That had been the promise of them. Capital was cheap for these companies because capital markets were treating them as such. If that changes, it's going to be more difficult for them. And at the same time, if you don't know whether they're going to get the return on investment, why own them? Why not own the thing that they're spending on, which are these chip makers?
So let's focus on OpenAI, potentially pushing back this IPO. The why, I'm sure there's a number of reasons, but let's pick out just one. Competing with a supply monster right now. Alphabet with an upsized equity offering in the last month or so. We've got the likes of SpaceX with a record-breaking IPO. And just in the last week, forgotten about this already, SK Hynix proposing a $30 billion ADR sale, which alone is one of the biggest equity offerings we've ever seen in this equity market.
It's a supply problem. And look, if OpenAI decides to delay their IPO, we've got to worry about the rest of this market and what else can IPO. Because it had been a market where people said, yes, it's an open market, but for the right company. If OpenAI, one of the foundational LLMs, is not the right company, then what is?
You wonder what it means for the likes of Anthropic, still on track for something later this year. We'll see. Danny's with us all morning. Lucky to have her with us because the likes of Annmarie and Bramo are taking a very long weekend. Lisa calls Aspen work, by the way. Just for the
Aspen
record.
In the summer. What a tough go.
Aspen in the summer apparently is work, so good for Bramo. After Rio, I'm not jealous or envious, of course. Equity futures right now in the S&P 500, negative by 0.6%. Coming up this hour, we'll catch up with Cam Dawson of NewEdge Wealth as the tech sell-off snowballs. Sarah Kunst of Cleo Capital as OpenAI considers postponing its IPO. And Claudia Sahm of New Century Advisors on the Fed's path back to 2%. We begin this out with stocks sliding as AI spending concerns rattle investors. Cam Dawson of NewEdge Wealth writing, truly everything hinges on one thing. How long will hyperscalers be willing to throw all their capital into AI infrastructure, mostly as the market punishes their stock prices? Cameron joins us now for more. Cameron, good morning. Good to see you.
Good morning.
Cam, is this sustainable? What's your view on things?
I think the only reason why Micron's able to post 830% earnings growth in the year of 2026 is because the hyperscalers are willing to reach very deep into their pockets, burning all of their free cash flow in order to build out CapEx, tapping the debt markets, now tapping the equity markets. And I think the big question is how much more upside is there to hyperscaler CapEx spending? The reason why we've seen so much upside to the AI infrastructure earnings this year is because people have revised higher their hyperscaler CapEx numbers, up from 30% to start the year to now 90%. So when you look into 2027, people are expecting 20 to 30% growth on top of this year's 90%. The question is, where does that money come from? We're talking about hundreds of billions of dollars, and there's a really big question as to whether or not this equity market will have the patience with these hyperscalers to wait for the returns to come.
At the moment, that patience is wearing thin. I've mentioned that quote from the Alphabet executive a number of summers ago when they came out and said the biggest risk here is underinvesting and not overinvesting. That really set the tone for the amount of capex we've seen. How sensitive do you think that argument will be to the pushback that's developing at the single name level.
Yeah, when you tell everybody that you're in an arms race and it's an existential crisis, this is not necessarily something that you would correlate with higher margins. And I think the challenge that we have is that these companies used to be such capital-light businesses, and that was who they were at their core. Now they're morphing into these highly capital-intensive businesses, and the really big question is whether or not this is a good place to allocate capital where we'll get the kind of returns that we got in their legacy businesses, which were monopolies and capital light. Now we're capital intensive and competitive, which says to us these are lower return on invested capital businesses. And we think that's why the market has been punishing them. If you look at their returns, the reason why they're down is not because of earnings. Earnings are still being revised higher for all these companies. It's because you've taken 10 multiple turns out of their names. The Mag 7 used to trade at 35 times at the peak last year. It's now at 25 times. So this is the market saying we don't like the deterioration in free cash flow generation. And I think that's why you're seeing this multiple compression.
Karen, I just think about what are the consequences for so many funds that have decided that they just want to be an AI infrastructure bet. Coatue, the hedge fund, opened up an AI infrastructure strategy. John Gray from Blackstone was at a conference saying Blackstone is now an AI company because AI infrastructure is the future. If those hyperscalers stop spending, what happens to that entirety of the ecosystem?
It's one of the things that we've been wrestling not just within public markets, but within private markets as well, where you're signing up for 7 to 10-year fund lives. And yes, we can acknowledge that today, at this very moment, there are very distinct supply shortages. There is so much more demand for compute than there appears to be available capacity. But as we know, whenever you have supernormal profits, it tends to draw on capital, draw on competition. And so if we're looking for 7 to 10-year kinds of investments, as you would say with the Blackstone, who is a private market player, that the question is, does this supply-demand imbalance remain during that entire fund life? So I think it's a really, really open question how long this supply-demand imbalance actually persists.
These are some big unknowns. So what takes the mantle in the big time? Is it the semis that these hyperscalers are spending on? Is it banks? Is it something cyclical, totally separate from the AI trade?
I mean, I think the story of the last month has been the rotational market. You have the dynamic where you have the S&P 500 flat on the surface, but you have 10% more names above their 50-day moving average today than you had at the start of June. So this is all this big rotation underneath the surface. It's not necessarily people running for the hills from equities overall. You add on top of that something like the Russell 2000 outperforming Mag 7 by 27% this year. But there's a really big caveat with Russell 2000. We get the rebalance at the end of this month. And all of the big names that have driven Russell 2000 outperformance are actually graduating up into the Russell 1000. So the challenge you have is that your biggest winners are moving out of the index. So it's effectively like saying that the Knicks, if you traded all the players away, are they still the Knicks? That's effectively what's happening to the Russell 2.
And we've got a rate hike debate on the horizon as well.
Yeah.
Somewhat linked to the tech story, we're seeing these companies, Microsoft, Apple, pass on these higher costs. Consumer electronics are going to go up in price. And even though we've had a reset in crude prices, we've had a firming in rate hike bets over the last month. What do you make of that disconnect?
What a brave new world that we're talking about goods inflation being persistent. For the last 20 years, goods has been a source of disinflation or actually outright deflation because of globalization, because of productivity. But ever since the pandemic, and then you had tariffs, and now you have AI, you're in a world where goods inflation has been far more persistent. Now, the good news on the other side of the inflation story is that wage pressures are not there. So you're not seeing the same dynamic of wage price spiral, and you don't have pressure from housing as housing continues to be in the doldrums due to the high rates at the long end of the curve. So the combination of everything means that high goods inflation, services maybe not as bad, but then you also have to contend with the potential that we could see negative headline prints on CPI just because of falling oil prices. So we think maybe peak inflation fears might be behind us, at least in the very near term.
So I'm not expecting a 22 repeat, a Fed that's got to scramble. We can't by definition go from 0 to 5 again. But could we see 3 hikes in the next 6 months?
I think that it really depends on whether or not we see more pressure on this inflation spreading to other areas. And I think the fact that core PCE is still at 3.4% would be the one reason that you would argue for rate hikes. And I feel as if, and this is really coming in very similar to what Dada was arguing, which is that because Warsh abstained from providing a dot. He effectively was opening up the door for those rate hikes by saying, look, it wasn't me, I didn't do this. And so that effectively is giving room to potentially hike rates. But if you're in an environment where CPI on a year or on a month-over-month basis is negative on a headline basis, it's hard to see the Fed hiking in that environment.
Still, it's a market that maybe has less reality checks on exactly where we're going. If you don't have a Warsh who's as present and as transparent as Fed chairs in the past, does that just lead to more volatility then?
Yeah, we've been thinking about the lyric from the Rush song a lot, which is, if you choose not to decide, you still have made a choice. And I think that choosing not to decide in the near term was effectively opening the door for the hawks, as I mentioned. And I think the big question will be, as we get later into the year, as we see the market still pricing in a 120% chance of a hike, so more than one hike through the end of the year, do you actually see him push back against that in any way? At this meeting, it certainly wasn't the case. He talked about fighting inflation, but it's really important to remember, you have $10 trillion of Treasury debt outstanding that has to be refinanced this year. 85% of that refinancing is coming at the short end of the curve. So if there's one person who really, really, really wants short-term rates lower, it is Secretary Bessent, because of the Treasury financing pressure.
You were in the room with Bessent this week at the event at the Economic Club in New York. Was that a green light to hike rates?
I think it wasn't a red light. So I think it was support of this hold and wait and see. It wasn't an all-out, we have to cut rates. You didn't see this argument coming from Bessent talking about, because of AI, because of efficiency, that you have this huge runway in order to be able to cut rates, that the neutral rate is lower. It was effectively whatever the data supports. I think the most interesting thing from Bessent at the presentation was the talk about globalization and margins, and the fact that effectively you used to optimize supply chains for margin, for efficiency, and now you have to optimize supply chains for resiliency and redundancy. And that says to us, in the last 20 years of massive margin expansion on the back of globalization, does that come into question?
We'll talk more about that in a moment. Cam Dawson of NewEdge Wealth. Twos right now this morning in the bond market, 2s, 10s, 30s. Yields coming in just a touch. We've had a reset at the front end of the yield curve. Danny, we've gone from 4.20 down to some 4.1%. So yields have declined through the week.
Yeah, they've declined pretty massively. Maybe that's the back of oil. Interesting to see that we haven't seen any yield pickup around the Apple story, some of the fears of AI-led inflation. That's not being priced into this market yet.
Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Iran striking a cargo ship in the Strait of Hormuz. Multiple sources reporting Tehran was behind the first reported attack since the interim peace deal between the US and Iran went into effect last week. OpenAI is leaning toward holding off on an IPO until next year. The New York Times reporting bankers cautioned that recent volatility in tech stocks could dampen enthusiasm from retail investors for OpenAI's offering. The US finishing its World Cup group stage with a 3-2 loss to Turkey. The Americans already securing a spot on the knockout stage, though. Team US will face Bosnia-Herzegovina in the round of 32 on July 1st. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Everybody's loving this. You see the Dutch in Kansas City yesterday. You seen the pictures of that?
Oh my, it's been
Wild.
the best thing to watch, I have to say, just like all the Europeans here. I also, that whole narrative of like, oh, Americans are so wealthy, everything's so expensive here, they're all going to Europe for the summer.
Sure.
The opposite's happening. I'm shocked.
Seeing Europeans fall in love with America and America fall in love with European football fans. It's pretty cool.
I agree. Also, like, the Norwegians have been really good.
The rowing.
The rowing.
Yeah.
Yeah.
A lot of fantastic scenes across this country and more still to come over the next several months, several weeks. Up next on the programme, claiming total control of Hormuz.
The Strait is open. Yesterday, they took out 19 million barrels of oil. That's the most in the history of the Strait. And the oil prices are dropping like a rock.
Up next, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Four days, no gains on the S&P 500 this morning, pulling back by 0.5. It could become day 5. We're down 1% on the Nasdaq 100 this morning, negative by 1.1. Yesterday, not great for Apple. Apple down by something like 6%, down double digits in June. Microsoft, similar story. Microsoft softer yesterday, down more than 20% so far this month, attempting to pass on higher costs, this market rejecting that effort.
One of the things that I've been really interested in is the finger pointing about who's responsible for this. Micron, one of the executives, gave an interview to the Wall Street Journal saying they didn't name Apple, but essentially this is Apple's fault because when prices were rock bottom in 2023, they were insisting that they also pay rock bottom prices so we couldn't make new investments. I wonder how many of these tech players are going to learn from those scars, and maybe we don't get that cyclical pricing anymore for these memory chips.
Apple this morning up by 0.4%. Let's turn to the bond market. 2s, 10s, 30s. As of yesterday, 2s were down for 3 consecutive sessions. That's the longest run we've seen on a yield basis going back to April. Make it day 4. It becomes the longest since January. We've had a reset here. We're down to about 4.1% on the 2-year, but that rate hike conversation is not going anywhere.
And Bank of America still has 3 rate hikes penciled in for their forecast, which has been a big topic of conversation. The idea of a rate hike not necessarily being batted away from any of the recent speakers, too. Scott Bessent not necessarily batting it away either. So it still remains alive and present. It's still being priced in at least one in this market.
Speaking of reset, check out crude. It's just amazing to see. Every time I see us in the 60s on WTI, just to get your head around this, 69 on WTI and wiping out a wartime rally. I mentioned this yesterday. It's an old cliche on Wall Street. You want to make a fool of someone? Ask them for a forecast on crude, right? And that's been a story of the last 3 months.
What happened to all of these energy experts who were saying at some point the physical market's going to catch up with the paper market? The Strait of Hormuz has been closed for too long. Energy isn't flowing. I don't want to say been made a fool of, but that hasn't come true. I mean, it is remarkable to look at this.
Brent crude 72, WTI 69. Under surveillance this morning, claiming total control of Hormuz.
They want to make a deal with us very badly, and we probably will. I think we will, but the Strait is open. Yesterday, they took out 19 million barrels of oil. That's the most in the history of the Strait. And the oil prices are dropping like a rock. And, as goes oil, so goes everything else.
So here's the latest this morning. The president touting the free flow of crude through the Strait of Hormuz as an attack on a container ship undermines efforts to restore traffic through the crucial waterway. With the latest, Tyler Kendall joins us for more. Good morning, Tyler.
Hey, John, good morning. Well, a White House official tells us that the U.S. is looking into which party is responsible for this attack, including whether it was ordered by the highest levels of the IRGC or perhaps was a rogue decision by lower-level personnel. For now, it doesn't appear to have totally derailed the reopening process in the Strait, as new data analyzed by Bloomberg News still shows that ships are continuing to transit through, though it does risk, of course, undermining commercial shippers' confidence. As we heard from the UN's global shipping regulator yesterday, that they're actually going to pause evacuation operations until there's more clarity around this attack. And Iran is still maintaining that ships still need their permission in order to transit through. Just yesterday, we saw at least 3 supertankers reportedly turn around after they had orders from the Iranian Navy not to cross. Now, the U.S. Secretary of State Marco Rubio was asked about this by reporters overnight. He said that any deal where Iran tries to maintain control or charge fees or tolls in the Strait would not be acceptable to the U.S. But, John, it's very clear that it is on the mind of Iran, because just yesterday we got this report from the Wall Street Journal that the country estimates that it could make $40 billion a year in revenue if it charges tolls related to what is being called navigational or environmental services. And not just that, the reporting goes on to say that Iran is considering asking other countries in the Middle East and maybe even China if they would be willing to share in on the costs and the profits of any such system.
Tyler Kendall, thank you. Tyler, down in Washington, D.C., there is a political question. We'll spend some time on that in the next hour. There is a market question. The market at the moment does not care how the energy moves, just so long as the energy moves. And crude at the moment is moving as follows. We're down by 3% on the session. WTI back to 69. Brent at 72. And maybe the most provocative quote of the week actually came from Torsten Slok over at Apollo, who wrote the following. The narrative in markets is changing from lower oil prices mean lower inflation to lower oil prices mean more demand in an already overheating economy, which means higher inflation. Cam Dawson of NewEdge Wealth still with us. Cam, what's your reaction to that quote from Torsten this week?
Oh, I mean, this idea that potentially the savings from gas prices could fuel spending in other areas and drive higher inflation. It's possible. I mean, look, you're going into an environment where you had this shock to consumers because of higher gasoline prices. And I think it's important to note, gasoline prices are still 30% above where they were prior to the war. So you don't have the same kind of reaction function that you have in paper oil prices. But you had the shock to gasoline prices, which has been somewhat offset because of OBBB, meaning tax cuts have really allowed consumers to continue to spend. And what we see from the data and from different banks is that consumers are spending these tax cuts really, really rapidly. And look at the Redbook retail sales data. Redbook retail sales is accelerating. And maybe that's because of some catch-up where people were pausing some spending as oil prices were rising a lot, but it's running at its fastest pace since 2022. So this is really notable that even though we're talking about a period of negative real wage growth, you still have accelerating retail sales. And I think the last question that's raised in all of that is how much of this is driven by the wealth effect with very strong margins, or very strong markets. So if you have a shudder in markets, could you see that get hit?
I think that's such an interesting question because we have seen household wealth, that exposure to equity markets be at an all-time high. What is the level in which you'd start to get worried that that wealth effect is turning negative, that you have enough of a decline in equity markets that brings the thing that sort of dampens consumer spending?
It's not just the level, it's the duration. Because if you have a short, sharp correction of a 20% like we had in Liberation Day or coming out of the start of the war, and you have a very quick rebound, what effectively happens is you don't have statement shock. Because you have to have that statement shock at the end of the month or the end of the quarter to go, oh my gosh, I have a lot less money than I thought I did. I need to tighten the belt. But because we have seen rapid declines and then very rapid rebounds in markets, that's effectively meant that any volatility that we have has been stomached very well from a wealth effect perspective.
Is it worse this time, though? Because not only are we thinking about just your plain vanilla equity markets, people owning like the S&P 500 fund, for example, but a SpaceX IPO that had so much retail interest, poly market, betting markets, the casinofication of anything, just given the amount of different financial instruments that retail investors are now participating, does this make the problem all the much worse?
I would add to all of those examples the huge surge in leverage that we have seen. And that leverage is coming from multiple areas. It's not just FINRA margin loan balances, which we know are at a record, but it's also options activity. Long call options have surged higher. It's also leveraged ETFs. If you look at leveraged ETF flows, they've been absolutely enormous. And it's not just in the U.S. We're hearing huge signs of leverage out of Taiwanese investors, out of South Korean investors cashing in on life insurance in order to buy more semiconductor stocks. So there is a ton of leverage that has been put into this market in order to chase the rally. And we know that leverage cuts both ways. It's really fun on the upside, but it's a lot more painful on the downside.
Do you think it's beginning to contribute to volatility?
I think so. I think that that's one of the reasons why we're seeing this amplification of downside moves. And I think the really big test is that if we get to resistance, something or support like a 50-day moving average, and we break through it resolutely, we break through the next one, then we could actually start to see more of a deleveraging. And one of the reasons why we've said, look, you have to respect the uptrend in the market. That 50-day moving average has held so well since the April lows or the March lows. And we've seen dip buyers continue to step in. The big question is there still money on the sidelines in order to be dip buyers? I'd say potentially yes from institutions. You had an outflow from equities this week from the Bank of America data, but also look at the Deutsche Bank consolidated equity positioning. It's in the 42nd percentile. So as much as retail is all in on this market, institutions are very much sitting on the sidelines just being neutral.
Cam, it's good to see you. Appreciate your time, as always. Cam Dawson there of NewEdge Wealth. The amount of leverage being taken in South Korea. Have you read some of those stories?
Yes,
terrifying.
I mean, retirees looking at cashing in things. But here in the U.S., also these leverage ETFs like 2 times Micron or whatever, there's been a lot of chatter that they're now having a hard time finding banks who are willing to take the counterparty risk because these things have just shot up. So they're using weird options. It's increasing some of the tracking volatility. It's strange times in these leverage
Things can move south quickly and take on a life of their own in those kind of situations. Coming up next on the programme, we'll catch up with Sarah Kunst of Cleo Capital as OpenAI weighs a delay of its IPO. Plus, Yahira's with us. She's got your morning movers. Memory stocks falling on new fears for demand. Micron this morning down 5%. 4 days, no gains on the S&P 500. That's the longest such run going back to the middle of March. We might extend it. We're down this morning by 0.5. On the Nasdaq 100, we're down by more than 1 full percentage point. These moves come on a week where we've seen a series of upgrades to price targets on the S&P 500 from Wells Fargo, from Barclays, from JP Morgan, from SocGen, lifting their price target to 8K. Manish Kabra saying stronger and more persistent earnings cycle, the story behind that move. But ultimately, who's getting the earnings? Who's got the margins right now? And it's that number of companies getting smaller and smaller.
86% margins for Micron is what they're expecting in the fourth quarter. That's good news for them and bad news for everyone else. And the earnings could be good for all these other companies, but it's the years out. It's the terminal value. And at the end of the day, that's how you price stocks. It is not the earnings today. It's the earnings in the future. And how do you calculate that exactly with the return on these massive investments from the hyperscalers?
It's been quite a volatile week. Seen much of this in South Korea, again here stateside. Nasdaq futures for now. See if it changes, but for now, down by more than 1 percentage point. Danny and I have already talked about the bond market, but it's worth going over once again. We haven't seen a 4-day streak of lower yields at the front end of the curve since the start of the year. The 2-year down by 3 basis points this morning, 4.09%. Now, just maybe we're starting to see a recoupling between this market right here and this market right here, which is the commodity market, because we have had a real break lower in crude prices, wiping out the wartime rally. WTI back to about 69. Brent crude, you switch on the board, into the low 70s. Brent crude this morning at 72. We're down by close to 4%.
It is remarkable that we were able to take 5 million barrels a day of oil off the market, and the economy is fine. Maybe part of what we're seeing here is this acknowledgement that we don't need as much supply as we really need. So if you start to get ships that traverse the Strait of Hormuz again, what are we talking, like $50 a barrel, maybe even lower? The world doesn't need as much crude as maybe we originally thought, and their stockpiles, yes, those will need to be refilled, but we have coped remarkably well.
Brent crude this morning down by close to 4%, 3 hours away from the cash open, the opening bound just around the corner. Let's get you some morning movers, some single names. Yahira has more. Hey, Yahira.
Hi, John. The memory and chip trade is faltering this morning. As you can see, it started over in Asia with SK Hynix under pressure. And now here in the pre-market in the U.S., we are seeing names like Micron and Nvidia both falling in the pre-market as investors increasingly worry about demand destruction after we heard from Apple and Microsoft that they are hiking prices due to higher component costs, fueling concerns about whether that could eventually slow demand. And not helping sentiment is that report that OpenAI is potentially considering delaying its IPO. Sticking with the chip sector, we are seeing onsemi under pressure, falling nearly 13% in the pre-market after it announced an all-stock $6 billion deal to buy this company right here, Synaptics. But investors clearly not convinced. Synaptics is a company that supplies chips for things like laptops and smartphones. And reading through analyst notes, what they're saying is that this takes onsemi further away from the data center story, which has been what investors, of course, have been buying into. And we end on space with Rocket Lab. Those shares up 2% in the pre-market, a rare bright spot in this market after this company won a new NASA launch contract. It comes after the stock fell some 25% this week, caught up in the sell-off across the space sector as sentiment soured over SpaceX and its lofty valuation. John?
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, a top story. SoftBank shares plunging by the most since 2024 following a New York Times report that OpenAI could delay its IPO until next year. SoftBank holding a roughly $65 billion stake in the AI giant. Elsewhere, the race to succeed JP Morgan boss Jamie Dimon heating up. The world's largest bank naming 2 new co-presidents seen as top candidates for the role, with Dimon saying the changes mark an important step around succession planning. And finally, the Chicago Fed President, Austin Goolsbee, ready to move on from forward guidance.
That sparse statement that is purged of forward guidance has a bunch of the financial analysts like, whoa, what does this mean? We're used to having more information. I have always been uneasy with the use of forward guidance on a routine basis. Anytime you hear the Fed officially making a prediction that doesn't turn true, the credibility takes a ding.
The Chicago Fed president signaling support for Fed Chair Kevin Warsh's communications pivot, going on to say he doesn't hate The dot plot.
It's important to get this kind of talk from other Fed officials because there had been this concern, and I know, John, you've talked about this. If you don't get a Kevin Warsh who gives forward guidance, do the other FOMC members just take his place? Do they come out with really hawkish sentiment? Is that what the market starts to pay attention to? If you get other members on board with this idea, if you don't have forward guidance, you curtail some of the communication, then yes, Kevin Warsh can reach this aim of trying to keep things a little closer to his chest.
People are filling in the gaps. We've talked about this numerous times, Danny. I know you have too. That ultimately, because the Fed didn't offer much, the Fed chair didn't offer much last week, people have drawn their own conclusions on what it all means. They're confusing a potential change in style with a potential change in policy. And we had a Fed chair just last week, not just reluctant to provide guidance, but also reluctant to really articulate the reaction function of the Federal Reserve, which complicates things even further, not just for the institution, but for the people following the institution.
Well, part of the reason that Feds past, I mean, really over the past decade or so, have tried to give more of a forward outlook is because how the market reacts to the Fed impacts financial conditions, and financial conditions impact economic outcomes. So if one is volatile, then economic outcomes will also be volatile, which is why you get this guiding hand from the Fed. So maybe if we're in a different regime, you have to prepare for that type of economic volatility.
The Fed chair has some time. It certainly does.
True. And he has some task force to figure it out for him, too.
Exactly. And maybe that offers them the time they require before they have to make any decisions. We'll see. The 2-year this morning down about 3 basis points. As I say, it's a break of 4.1% at the front end of the yield curve. Let's get back to that top story. OpenAI reportedly weighing a delay to its IPO until next year. According to the New York Times, advisors for the AI giant are warning volatility in tech stocks could dampen enthusiasm. Sarah Kunst of Cleo Capital writing, OpenAI has been the sick man of the unholy trinity of trillion-dollar IPOs. They're bleeding cash. Many of their business plans haven't panned out, and Sahm Altmann has long been ambivalent about life as a public company CEO. Sarah joins us now for more. Sarah, welcome. A simple question from me, first of all. Do you think this is an OpenAI problem or a broader capital markets issue?
I think this is a Sahm wants to go public at a $1 trillion valuation problem. If you read that report, they're not saying the IPO is necessarily a bad idea. They're saying, hey, you have to look at reality. You have to look at where revenue is and take that IPO price down for it to perform well. And Sahm says $1 trillion or nothing. And so it looks like they might delay.
Sarah, do you think the capital markets backdrop, though, is making it more difficult? The fact that Alphabet got out so quickly with a massive equity capital raise, that SpaceX came first, and they have this slightly confusing, as you've put it, staggered lockup over the next 6 months as well that might disrupt capital markets too?
Absolutely. You generally, in a sort of frothy environment, want to be an earlier IPO. As more and more IPOs happen, it's likely Anthropic, if they decide to go public this year, will go public, faster than OpenAI can. And so you end up being sort of at the tail end. All of that sort of excited, manic, Main Street energy has already gone into other names where they're maybe getting burnt a little bit because it is normal after the initial IPO pop to see a pullback. And we know that we're in this K-shaped economy with sort of the shaky consumer. We know that Wall Street is sort of less of a buyer of some of this stuff because they already have loads of exposure, from what they've been doing in the private markets. And so, it's a tough time to go public under the best of circumstances. And when the whole goal is to get this historic number, that makes it really difficult.
Relatedly, Sarah, in the Times story, when they laid out how their advisors were talking to OpenAI, they said to them, post SpaceX, you're not going to find enthusiasm from retail owners, from retail investors for its shares. Sarah, does that underscore just how important of a force retail investors have become for these AI giants as they consider IPOs?
I don't think it's for AI giants. I think it's for companies that want to feel a little bit like a meme stock. When you look at OpenAI and the frenzy around it and the excitement and the sort of fanaticism, it doesn't feel as much like an analyst reading, SK Hynix reports as it does the GameStop glory days. And so I think that they were depending on that frenzy to be able to give them a valuation that doesn't really make sense when you look at the numbers. And because that frenzy frenzy is dying down around the AI trade in general, and because there is backlash to data centers. We're not in that same moment that we were in a couple years ago when everybody thought that AI was 100% good and would 100% go to the moon. I do think that that's impacting their ability to go public.
And we have seen more government involvement. Just on that point, Sarah, there was an information story yesterday that OpenAI has been asked to stagger the release of their most recent model, their most advanced one, by the White House in similar ways that Anthropic had been asked to slow their rollout. How difficult does that make these business models if you do have a government that's getting increasingly involved, chatter about taking stakes in these companies, or the ability to just turn off a switch with some of the models?
I think that certainly doesn't make things easier. It might not be all bad for OpenAI to be seen as having a super powerful model similar to Anthropic's Mythos. So I wouldn't say that it's 100% bad. I think Sahm has very consciously cultivated a very close relationship with Trump and with the White House, and certainly has worked closely with them on Stargate and other things. So he wants to be on the right side of this administration, and I think he's willing to play ball. But I do think that for the broader market, you have to look and say, wait, we're going to pay all this money for this company because they're going to sell these models to people unless they wake up on a Tuesday and they can't. And that kind of uncertainty is not really ideal.
Well, Sarah, let's get to the debate of the moment for the whole AI ecosystem, and perhaps I can reduce it to the performance of two names so far this month. This month, Microsoft is down by more than 20%. Micron is up by more than 20%. That's a 40-point plus gap in performance for this month between the companies doing the spending and the companies receiving all that spending. Sarah, how sustainable do you think that is?
It doesn't really worry me. I think that that's actually the market sort of kind of correcting itself, right? You should, when you look at it, say, hey, your prices are going up because you have a lack of supply and really high demand, and the people who need to buy that product, obviously we're a little bit more worried about them. And so I think that that's a pretty healthy market reaction, and that with the Microsofts of the world, you're seeing sort of a right sizing where there's been this sort of irrational exuberance over the last few years around Microsoft, mostly tied to their OpenAI bet. So you also have to look at that. If sentiment around OpenAI is weakening, you're going to see some of that in the Microsoft price pullback too.
You don't expect to see a deceleration in CapEx?
I think that we'll hear more and more about that. The thing to remember over the next few years is a lot of this CapEx isn't quite real, right? These are data centers that are going to be built. This is not money that's necessarily already been deployed. In terms of the human cost, right? In terms of these super expensive AI hires, in terms of the M&A, all of that, they can always pull back on that. They can slow down on that. They can get rid of people if they really need to. And then on the other side, they can decide that, hey, maybe we don't need half of Ohio as a data center, right? And I wouldn't be surprised to see some pullback on that development, both because of demand sort of weakening as well as local pushback. One of the big things in the AI story that we really have no idea about is how many people are actually using it on a regular basis. None of the big AI labs break out those numbers to say, here's exactly how many daily users we have, here's exactly how many subscribers we have, and here's how sticky we think it is. And so it could be that the demand isn't skyrocketing the way people think it is.
Interesting. Sarah, thank you. Appreciate it. Sarah Kunst there of Cleo Capital. Nasdaq futures this morning down by 1.2%. The S&P 500 negative still by 0.5. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Good morning. The death toll is rising in Venezuela after back-to-back earthquakes struck west of Caracas. At least 188 people are now confirmed dead, more than 1,500 injured. The government is creating an initial fund of $200 million for repairs to infrastructure, hospitals and housing. Samsung and SK Hynix are planning to announce huge AI spending Monday. South Korean media reporting Samsung Group will announce a $646 billion spending package over the next decade, the largest plans in the country's history. The heat wave in Europe is officially the worst severe weather on record. According to a new report, temperatures this month were between 5 and 12 degrees Celsius above the seasonal averages across France, Germany, Italy, Spain and southern England. And that is your Bloomberg brief. John.
Bonnie, thank you. Welcome to summer. In the 90s, in Europe as you've lived it.
Yes.
It's very different to the 90s living it here in New York.
Because there's no infrastructure for it.
Nope.
My flat in London did not have air conditioning. Most don't. And so there's like people just go to the movie theaters and just sit there for hours because they're like, I need to find something that has air conditioning.
Mine just had a little radiator, right? And then you'd open the window.
Right, exactly. That's all you needed.
And hope for the best. Yeah, it's not a great strategy when the temperature's that high. Up next on the programme, taming high inflation.
There's been a kind of a disturbingly high component of services inflation. I do think it's worth keeping an eye on that.
Up next, we'll catch up with Claudia Sahm of New Century Advisors, live from New York City. You're watching Bloomberg Surveillance. So this is a struggle once again on the tech side of things, taking down the Nasdaq by more than 1%, on the S&P 500 down by 0.5%, on the Russell, which is where you've seen a lot of outperformance through much of the year. The Russell this morning also on the back foot, we're negative 0.6%. Well, let's compare two asset classes just briefly. We've done this a few times already this week. I think it's worth doing again. Check out the bond market. Yields down for 4 straight days at the front end of the curve. So twos have reset to about 4.1%, but twos are still about 70 basis points higher than they were before this war started, whereas crude has completely reversed the gains. How much more work is there still to do there, or how independent is the rate hike debate from this screen? Brent crude this morning, 72. Danny, WTI at 69.
Well, there are different possibilities for this. For one, oil and treasuries have been decoupled because we're now paying attention to the Fed, and we've interpreted the meeting the other week as hawkish. The other one, and you brought this up, is Torsten's lock, that by having lower energy prices, you have consumers who are willing to spend more, and that in itself pushes up inflation. So the relationship between the two have flipped.
So you can afford the new Mac or the new Xbox.
Sure, yeah, you can pay
instance,
20% more because your gas pump is
just keeps going up in price. It's crazy. Under surveillance this morning, taming high inflation.
There's been a kind of a disturbingly high component of services inflation, which isn't really from oil prices. It isn't really from tariffs. Why is it high? Historically, that's a pretty persistent type of inflation, so I do think it's worth keeping an eye on that.
So here's the latest this morning. The Chicago Fed President Austin Goolsbee warning core inflation is heading in the wrong direction, as New York Fed President John Williams forecasts the central bank won't reach its 2% target until at least 2028. Claudia Sahm of New Century Advisors writing, the critical question is what it will take to get back to 2%, and the distribution of price changes that add up to headline inflation now offers some clues about the trend. Claudia joins us now for more. Claudia, always a pleasure, privilege to catch up with you and talk about these trends. Let's pick up on that last line. What are the clues right now that offer you an idea about where this is going?
Right, well, I think it's useful. You know, people say, oh, the inflation data, it's backward looking. And certainly May inflation does not pick up all of what we've learned in June about the negotiations in the Middle East and energy prices coming down. But in those inflation data are a wealth of information about various price changes in the economy. The BA publishes almost 180 price series. So we can go in and look at what are the big price increases, what are the big price decreases. A lot of times outliers don't stick with us in terms of, you know, staying with inflation over time. And then what's that, you know, that core of inflation? What's the central piece? Austin Goolsbee talked about it as the through line, like the part of inflation that'll keep going. And so I think there's a lot in the data that can potentially, you know, give signs about where inflation is headed. And that is very important for the Fed, because if they think it's headed back towards 2%, they may not need to do a lot more. If they don't think it's headed back to 2%, then that's where they potentially need to step in with rate increases.
Are you convinced it's heading back to 2%?
No, I'm not convinced. Well, and I think the other piece that should be coming out more in the Fed discussions is the patience, right? Like, how long does it take to go to 2%? And the clips you were showing, Williams was giving the very standard kind of, in 2 years, by 2028. But I'm not sure when most people heard in the statement, this committee will deliver price stability, that they're like, 2% in 2028. That's what we're talking about, right? Like, they may want something, if they want 2% much more quickly, like say next year, that's probably going to take some more extra effort from the Fed, some rate increases from the Fed. I do think this being at 4% inflation, I think there is an important piece of that is temporary with the energy prices. But this question of, like, have we settled in at 3%? versus the 2%, I think that one is a lot harder to answer. And we may be something closer to 3%.
Claudia, is it then troubling to have a Fed chair who wants to remake the Fed by introducing these task force? Many people have pointed to them and saying it allows for can kicking, that you don't need to make decisions until we get the conclusion of what these committees put together. Claudia, is it a problem? Does that play for time then translate into missing the window for critical interest rate hikes?
Well, the Fed should be able to walk and chew gum at the same time, right? Like there's a lot of questions about what they should do with monetary policy. There's a lot of tools about how to look at the inflation distribution, the different groups. I mean, the Fed has just a multitude of measures of how to look at inflation. They don't need a task force to measure inflation, but a task force might unlock some other ideas, throw some more ideas into the hopper. Like I think the task force have some potential upside. I don't think we should put too much weight on them and that they're going to really figure out like the piece to get us to 2%. But there's not much harm done at it. And while those task forces are happening, and they seem to be, as Kevin Warsh described them, mainly like external and some staff, the committee itself can be full on doing what they've been doing, try to wrap their heads around what's happening with inflation, what's happening with the labor market, and what they should do with monetary policy. We just probably aren't going to see as much of it out in the open because one of the task force on communication. But I don't think this is really holding up the Fed in terms of their process.
Well, on that last note, Claudia, you point to something of this idea of private access, something that everyone has always throughout history tried to get from Fed officials. Is it different this time, though, if the public access starts to dwindle?
So I think it's just we're going to have a lot more noise, a lot more uncertainty, and that we'll probably weather through that. This may not be a big deal. Trying, the guessing game of what does the Fed mean? What are they going to do? I don't see the merits of this. Like this is not the way I would approach it. But I think we can push through it. I think what's very important is that Kevin Warsh, as he pulls in the amount of public information, he needs to be very careful that the entire committee is pulling in any kind of private information that is coming out of the Fed, because that would be the absolute worst scenario where you have some real ethics issues where the information does get out, but it doesn't get out broadly.
Claudia, you've been on both sides of the wall, inside the Fed, watching the Fed. If you had free reign of the institution and you could adjust the communication apparatus over at the Federal Reserve, what would you change? What would you get rid of?
Oh, goodness. No, so I have been... in the time that I was at the Fed, I started in 2007. I watched a Fed that became more transparent, more speaking to the public. I do think it's very important for accountability's sake that the public, that Congress really understands what the Fed is doing, why they're doing it. And sometimes that means it's going to be clear they've made a mistake, right? Like if you show your work, sometimes it'll be clear you've made a mistake. So I think the accountability piece is so important. I think this fine tuning of how the Fed gives information so markets can understand it and can help the Fed do its job. Like that's part, it works through financial markets. There's lots of fine tuning. The dot plot is not a perfect tool in any way, shape or form, but the spirit of it, I think, has some real merit. So I think there's a lot of fine tuning, but I worry that it's very easy to delete things, delete tools, but that doesn't necessarily move the ball forward in terms of improving kind of the goal setting, improving the transparency, the communication.
Claudia, it's good to see you. As always, thank you. Claudia Sahm there of New Century Advisors. Is there addition and subtraction when it comes to improving communication at the Federal Reserve?
Again, but the whole thing of this is we have to wait, right? Like we don't know what the task force are going to come up with, so it might just be deletion. Maybe we do get some additional fun tools to add to our belt.
I just sense we go into a different world where we have a very different cadence for news conferences at this institution.
Which you've sat through a lot, so maybe that isn't the worst thing.
Yeah, I think a lot of people have sat through a lot of those and wondered whether we should be having them every single meeting. Up next, Alex Altmann of Barclays and a whole lot more from New York City. The second hour of Bloomberg Surveillance just around the corner.
I do think inflation right now is underestimated as a risk.
There is more inflation in the system outside of energy.
You kind of need to see core PCE running 0.2 or below for the Fed to feel more comfortable.
The case for monetary policy becoming a bit tighter is pretty compelling to me.
Those expectations around Fed policy are going to continue to jump around.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Equity futures negative. We're down by 0.5 on the S&P. We've gone 4 days without gains, and it could become day 5. On the Nasdaq, we're down by 1.2%. Check out Micron. What a strange situation. Micron this morning is down by 5% in the pre-market. 85% margins, a problem for everybody else. And because it's a problem for everybody else, it's a problem also for Micron this morning.
But like this thing also maybe is just because South Korea has had a bad day and a lot of the traders there maybe are exposed to Micron. It is just wild that on the same exact print, you can get Micron surging nearly 60%. And again, on the same story, Apple falling by 6%. It just feels like there's this really messy process happening in markets right now as we try to figure out exactly how these business models are working and who's winning and who's not.
We spent the last hour talking about it. It is the debate of the moment in financial markets. You saw Microsoft try and pass on higher costs. Stock hit. Saw the same thing with Apple in yesterday's session as well. The spenders, the hyperscalers have been hammered all month. In fact, for the last several months for the likes of Meta and Microsoft. And this major wealth transfer, in fact, one of the biggest wealth transfers we've ever seen in financial market history, from one group of names to another. And we're all trying to figure out how sustainable that actually is.
I also think one of the things that's worth paying attention to kind of goes back to the start of the year, but are these open source models? Because part of this conversation has also been, if you're an enterprise company, are you really going to want to pay up for how expensive this AI is? And there's been reporting that the use of these Chinese open source models has skyrocketed. And that makes it all the more harder for these hyperscalers to justify their spending, because you don't need all those data centers if you're using more efficient open source models.
Does it make it harder to IPO? The latest reporting from the New York Times suggesting that maybe OpenAI is going to delay that IPO into next year. Simple question, OpenAI problem or broader capital market story?
Or maybe Sam Altman problem, because he really wants a $1 trillion valuation when he goes to market. But it's hard not to extrapolate something for the broader market just because we came from this monstrous SpaceX IPO. And when you get the price declines and the volatility you just got from SpaceX, it doesn't make it as appealing to come to market because those investors have just gotten burned from SpaceX.
And they are not the only ones. We've had an Alphabet equity capital raise. I mentioned SK Hynix in the previous hour as well. I also mentioned that the SK Hynix $30 billion effort to raise capital through ADRs would be one of the biggest capital raising efforts ever on the equity side in the US, which just gives you an idea of the sums, the numbers we're talking about with regards to the capital race right now.
Are we going to get less of that? Is the confidence of companies to come to the market going to start to dwindle? Because at the end of the day, they are competing for a lot of the same institutional capital.
Futures this morning on the equity side of things, negative by 0.5% on the S&P 500. Next week, we won't be talking about tech. We'll be talking about tech. We'll also be talking about payrolls. Next week, payrolls Thursday, not payrolls Friday. Worth making a note of that going into next week. Data so far this week at the index level, headline level, been pretty decent, which is why that rate hike debate is still alive and well.
Which is, by the way, while you've seen this stock market volatility, all the other markets are pretty calm. I mean, treasuries starting to decline those yields, but not really moving that much. Oil markets have been really benign. The volatility has really been seconded to one part of this market. Everything else has been more stable because of the equity, because of the market data.
On the bond side of things, yields coming in 3 or 4 basis points, twos at the moment, about 4.08%. Coming up this hour, we'll catch up with Alex Altmann of Barclays on why a negative narrative might be brewing. Eddie Fishman of the Council on Foreign Relations following an attack on a container vessel in the Strait of Hormuz. And Jonathan Krinsky of BTIG on why he's expecting additional downside risk for the AI trade. We begin this hour with stocks failing to find a firmer footing as big tech concerns continue to grow. Alex Altmann of Barclays writing, I cannot be the only one whose spidey sense is tingling that at the margin there is a more negative narrative brewing around this beloved theme. Alex joins us now for more. Alex, good morning. Good to see you.
Good morning.
What are you worried about?
Okay, so there's really two things. There's a narrative, which I think at the margin is shifting, and we've touched on that already this morning. The other one is the technicals. And I want to focus on the technicals because I don't think there's going to be many individuals talking about this right now. So in the market, we've had this massive accumulation of levered ETF assets under management. So they're effectively products that are multiplying factors. So you buy one unit of it and it's buying multiple units of whatever that underlying is. And the AUM, or assets under management of that domestically, is now swelled to around about $220 billion. In Asia, it's swelled to around about $50 billion. And the reason it's so interesting is because the bulk of this swelling has come through the tech sector. So it's within semiconductors, and NASDAQ. And if you think about that's really captured the zeitgeist of the market. So as money has flowed into this narrative, it's been accelerated through the purchases of these levered ETFs. Now, the reason why that's interesting is because when those ETFs need to rebalance on a day-to-day basis, we get significant excess volatility. We're creating almost a short gamma profile to the market. So moves that go up are exacerbated higher, and moves down are exacerbated lower. So you increase the volatility, and we think that's been fueling some of the rally up. Cumulatively, these levered ETFs have bought $300 billion of stuff, mostly in the semiconductor and the US index space. But of course, the largest single stock levered ETF on the planet, SK Hynix out in Korea.
So let's get out to Korea. Just describe some of the technicals developing in South Korea at the moment with regards to the backdrop you just described.
Right. So, I mean, again, we sort of go back to this idea that you've had this huge accumulation of levered ETF within SK Hynix. It sits out in Hong Kong specifically as a single stock. You've got individuals posting on social media and they're wearing the vest of the particular ticker of this levered ETF, and so it's sort of again reminiscent of that euphoria that we saw, say, in gold at the beginning of the year when you had pictures of people taking photos of queues around the corner of people trying to buy bullion. It's this, and the same with silver.
And cashing in their insurance plans based on some of the reporting we've seen to do some of this.
We've heard anecdotes of that as well, though I can't confirm it. But the point being is that it's an illustration of a significant amount of retail excess. And, you know, we've seen pockets of this before. We saw it in the Kospi earlier in the year. We saw it in silver at the beginning of the year. Generally, these things don't end particularly well. And it's very much reminiscent of what happened with the levered VIX products back at the beginning of 2018. You remember you had this huge accumulation of short vol strategies. This is different. It's not short vol in the traditional sense. It's more the fact that you've just got leverage, this good old-fashioned leverage that's hidden within an ETF. And as a consequence of that, the more that things begin to move, the more excess volatility it's going to create from rebalancing.
Alex, is this you calling for a Volmageddon 2.0?
I'm not calling for a Volmageddon 2.0, but what I would definitely say is that if there is a shift in narrative, small shifts in narrative in AI, and again, we've talked about that, whether it's from IPOs potentially getting delayed, or whether there's the token maxing in reversal, or price cuts, or frontier versus open source models, these small changes in narrative can have much more dramatic price moves. And I think that's really what we need to focus on, is that you can have, remember, I'm a big believer that narrative follows price and flow, right? So what we're really talking about here is price and flow. And it's the narrative that people can suddenly change very quickly.
Just on one more point on the technicals in these leveraged ETFs. There has been some chatter around, for example, SOXL, one of the big ETFs that is like 3 times leverage, the Philadelphia Semiconductor Index, some other ones too, that banks on the other side aren't willing to give them the swaps. They're struggling to find some of the counterparty risk, and they're turning to more options. They're turning to unique ways to try to construct these ETFs. What happens when you get these oddities and how these ETFs are being put together? Is that very much so like a problem for these ETF providers, or can it have wider spillover effects into the market?
I think it's more of a specific issue to the ETF providers. At the end of the day, they issue a prospectus which kind of assures their investors, or they attempt to match the performance of the prospectus. So if they don't match that performance, then obviously they're on the hook, so to speak. But there's a lot of leeway in terms of if they don't match it, they just effectively do as a best effort. But I think the key point here is that you highlight if they cannot get access to the prime balances or the leverage through the traditional measures, and they're forced into the options market, all it's doing is creating a significant theta decay. There's a time decay of those options, which is going to drag on the performance. So again, it just may be a case of investors aren't necessarily getting exactly what they signed up for. I don't think it creates systemic issues, so to speak. I think this is more just a case of if we have, again, a change in narrative within the AI story, and again, at the margin, I think we are seeing that, it can create exacerbated moves, both to the top side, which I think we did see within the memory story, and possibly to the downside as well.
So you can go from mount up to mount down. It's one of the reasons you're tactically bearish.
Correct. One
of the reasons, or the reason you're tactically bearish?
It's one of the reasons. So I wouldn't say it's exclusively. I think there's a narrative reason as well why we're tactically bearish, and that's partly driven by the fact that we have our quantitative framework, which has sort of got a bunch of inputs that's sort of giving a warning, but then you've also just got this AI shift as well in narrative, which I just don't think is necessarily being fully appreciated. AMD at the beginning of the week, they came out with a desktop PC that they claim can take away a lot of the processing requirement from data centers. You've got price cuts. The things that we've already talked about, and also the fact that people are using 2029 forecasts as a reason to still be bullish a deeply cyclical sector such as memory is just a bit of a warning shot in our opinion. So there is a narrative, but I'm not going to lose sight of the fact that, yes, this is a very technical message.
If there was a space from a fundamental perspective, putting this all together to get long, given these developments right now, where do you see a pocket of opportunity in equities away from the tactical bearishness?
So there's two parts, right? And the first one is quality. I think quality's had one of the worst drawdowns in its history, if you just think about it from a factor perspective. Some of that may be within the hyperscaler narrative. I mean, if you're a hyperscaler and you're spending over 50% of your entire CapEx budget on memory, doesn't strike us as a particularly sensible investment decision. So actually, could the hyperscalers be bending the CapEx curve in the future? Could that be quite positive for that cohort of stocks? So that's a quality trade. The other one is commodities. I really want to get back to this commodity story. It's had a bit of a gut check recently, and the reason it's so interesting is that strategic autonomy narrative that we started the year thinking about, US and China decoupling, remember that? Rare earths, all this kind of stuff. And then also the Iranian story as well, and on the crude side, the need to have your strategic petroleum reserves, but also reserves of everything, right? So if we're moving into a world of strategic autonomy, then owning commodities, I still think, is a very interesting thematic.
How should I own them? Through energy players, through miners, through the actual commodities? How should I own them?
So we really like the miners. And the reason is that there's only $1.4 trillion of global market cap. Sounds like a lot, but that's basically the size of a memory company these days. So actually, the availability, the scarcity of these commodities equities is so interesting because, quite frankly, if you want to play the theme as a large institution, there's actually not that much equity you can buy.
Just a final question on tech. Can you imagine a world, not several years out, but in the next 12 months, where both hyperscalers and the chip players are doing well?
I can. Structurally, I know I sound a little tactically bearish, but structurally, I'm incredibly bullish.
The stocks, not the companies.
I still think there are going to be some inevitable winners from this, right? I think in a world where we're sort of somewhat focused on the ROI, we have to believe that there's going to be some ROI winners. And ultimately, we're talking about, from a hyperscaler perspective, these are some of the best capital allocators we've seen in our lifetimes. If you think about the bets that these guys have made over the past 20 years, they're virtually faultless, other than arguably maybe the metasphere, whatever. But the point being is that, do you really want to bet against these guys over the long term, over a cycle? So I think there will be some ROI winners. And yes, some of these hyperscalers I think will win.
Alex, good to see you.
Good to see you.
As always,
Thanks.
Thank you, buddy. Appreciate it. Alex Altmann there of Barclays on this equity market. Equity futures at the moment still near session lows, just a small bounce the last few hours. We're negative by 0.4% on the S&P and on the Nasdaq down by around 1%. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Yeah, just to recap a little bit about what happened in that volatile trading session across Asia. The Kospi closing down nearly 6% after triggering circuit breakers earlier in the session. The Nikkei losing more than 4%. Many reasons. Those synthetic products you've been talking about, of course, month end, obviously trading with 3 days left in the month, and maybe a little bit of anxiety over those AI trades. Volkswagen considering cutting 100,000 jobs and shuttering factories in a push to become more competitive. German magazine reporting VW's CEO announced the proposal at a management board meeting earlier this week. And from Wimbledon to Wall Street, the most decorated tennis star of all time is taking on a new challenge. Novak Djokovic is joining General Atlantic as the firm invests further in sports. The firm plans to lean on Djokovic's connections to push further into the health and wellness sectors. And that's your Bloomberg Brief, John.
Vonnie, thank you. It's great marketing, isn't it?
Yeah.
You hire him, we talk about it, and everyone's talking about General Atlantic.
Blackstone did the same thing with Tommy Fleetwood. I mean, it's Djokovic himself. He also has a partnership with the Altmann. He's doing pretty well for himself. He's like it feels like he's diversifying away from tennis a bit, which makes sense.
20 years ago, do you remember R9 had an internship at WPP with Sorrell? Am I making that up? I feel like that happened 20 years ago.
You can do better than an internship. Was it an internship?
I think it was something like that. Google it. I would do that, or ChatGPT. Whatever your preference is these days, depending on your generation. Up next on the programme, the presidential victory lap.
The Strait is open. Yesterday, they took out 19 million barrels of oil. That's the most in the history of the Strait. And the oil prices are dropping like a rock.
Up next, we'll catch up with Eddie Fishman of the Council on Foreign Relations, live from New York City this morning. Good morning. Welcome back to the program, live from New York. You're watching Bloomberg Surveillance. Equity futures right now pulling back by 0.5%. We're down by more than 1% on the Nasdaq 100. Declines on crude once again this morning. Brent down by 3%. Likewise on WTI, 72 on Brent. WTI in the 60s once again. Under surveillance this morning, a presidential victory lap.
They want to make a deal with us very badly, and we probably will. I think we will, but the Strait is open. Yesterday, they took out 19 million barrels of oil. That's the most in the history of the Strait. And the oil prices are dropping like a rock. And, you know, as goes oil, so goes everything else.
So here's the latest this morning. The president touting the flow of crude through the Strait of Hormuz. This as a container vessel was attacked, undermining efforts to restore traffic. Multiple networks reporting Iran launched the strike. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John. Well, a White House official tells us that the U.S. is looking into whether this attack was ordered by the highest levels of the IRGC or if it was perhaps a rogue decision by lower-level personnel. But regardless, it does mark the first such attack since the Memorandum of Understanding was signed, though for the most part, at least for now, it doesn't seem to have totally derailed the reopening of the Strait. However, some commercial shippers are now reviewing their exit plans, including one major company in Asia telling vessels that they should stay put for now, according to a recent message reviewed by Bloomberg News. Because new this morning, we saw Iran's foreign minister post on X reiterating that any vessels that want safe transit need to coordinate with the country. Because yesterday, it wasn't just this attack. We also saw at least 3 super tankers have to turn around after reportedly hearing warnings from the Iranian Navy. Now, the U.S. Secretary of State, when asked about all of this, reiterated the U.S.'s position is that there cannot be a deal where Iran maintains control or tries to impose fees in the Strait of Hormuz. But, John, we know this isn't the only point of contention at the moment, as we are now within this 60-day negotiating period. We're tracking very closely President Trump yesterday doubling down that Iran could use unfrozen assets to buy U.S. agricultural purchases, which Iran has denied. As yesterday, the Trump administration asked Congress for $11 billion in assistance to U.S. farmers amid the supply crunch from the war.
Tyler Kendall with the latest in Washington. Tyler, thank you. Eddie Fishman of the Council on Foreign Relations writing, Iran still has the ability to disrupt traffic if ships violate its wishes. Iran has shown that a U.S. adversary can weaponize a choke point and then get paid to stand down. Others will take note. Eddie joins us now for more. Eddie, good morning. Good to see you.
Yeah, nice to see you too, John.
It's advertised in the following fashion. No one's charging a toll. But ultimately, aren't they being paid to reopen the Strait of Hormuz?
Oh, definitely. I mean, that is what fundamentally the MOU is, right? If you go back to 2015, the Iran nuclear deal, the JCPOA, which a lot of people compare this to, in that circumstance, the United States imposed significant economic pressure on Iran and pressured Iran to give up concessions on this nuclear program. What has happened in 2026, this year, is actually the reverse. It's Iran, by using its key choke point, the Strait of Hormuz, has imposed significant economic pressure on us and has coerced us to give up economic concessions. The way you know that is that all the economic relief of this deal is front-loaded before anything on the nuclear side.
Your words, your language, others will take note. Who are we thinking about?
Pretty much everyone. I mean, because again, this is the second time that this has happened in as many years. China did the same thing last year with rare earth elements. They got us to backpedal our policy on China by virtue of cutting us off from that key choke point. If you're thinking about other countries that could do similar things, I mean, Indonesia is right at the top of the list with the Strait of Malacca. Their government has already brought up the possibility of imposing additional fees at the Strait. It's caused a lot of agita in places like Singapore and Malaysia. But that doesn't mean that over time they won't reimpose this type of thing. I think the Iranians came out yesterday and said that a toll at the Strait of Hormuz could be worth $40 billion a year for the Iranian government. Any other government sitting across one of these straits will see that kind of a revenue and imagine what they could provide for themselves too.
Do you think it will continue to work for these other players who take note, in your words? If it is something that looks like Indonesia, are other governments going to be okay with this? Or does there reach a point that there is enough of a pushback that this system becomes not viable?
That's the key question, Danny. I mean, look, what Secretary of State Rubio said yesterday, and I totally support his position, is that if Iran is allowed to charge a fee here, there's going to be chaos, right? You're undermining a core tenet of the international system, which is that waterways like the Strait of Hormuz are free and open to international commerce. So I do think it will require an international effort to stop this from happening. I think the challenge is, since World War II, that norm of free and open commerce has been underwritten by U.S. military power. And the U.S. military has just proven over the last 4 months that we cannot physically force the strait to be open. And so I guess the question becomes now, what are the Iranians going to do? Are they going to, target neutral ships like that Singaporean flagged vessel yesterday that defy it and take a channel around Oman, maybe don't pay a toll? But if they do, I'm not really sure what we're going to do about it.
Beyond the revenue from the toll, there's this question of the hundreds of billions of dollars that Iran is likely getting with this MOU, and where that money goes to. The White House has said it's going to go to things like U.S. agriculture. What do you make of this pot of money and how it's likely to be spent?
Yeah, so look, I think the most plausible way that this deal could be funneled to buy agricultural commodities is through the frozen assets that Iran has. They've got tens of billions of dollars of these frozen assets. And ostensibly through this deal, although the White House has not fully provided the details, in this 60-day period, we're going to provide at least $12 billion or so to the Iranians. The question is, how does that actually get channeled to buy U.S. agricultural commodities? So far, we've seen no evidence that it will. And the thing that makes me a little nervous, frankly, that this is more rhetoric than reality, is if you look at the one regulation that has come out, which is the sanctions relief on Iranian oil sales in this general license that came out on Monday, there are no restrictions whatsoever in terms of how Iran can use that money. It actually allows Iran even to collect the funds in U.S. dollars, which is something that the United States has not provided Iran for decades.
The Republicans used to criticize Democrats for taking those frozen funds and allowing them to do the same thing, to use it for humanitarian needs. But ultimately, the same criticism was leveled at them that we should level at Republicans too. If they're not using that money for that, what are they using the money for? If I've got excess capital now to spend on humanitarian needs, it means I've got additional capital to spend on the other things, like sponsoring proxies. How do we address that?
No, that's exactly right. Money is fungible, right? So, and Iran does depend on agricultural imports, right? They import grain, they import wheat, they import corn, a lot actually, soybeans from Brazil, a lot of the same countries that we compete with. So they're going to buy agricultural commodities, potentially from the United States. And again, I haven't seen any proof that that's going to happen. But to your point, John, even if some of that money is used for that, that frees up additional resources to rebuild their nuclear program, to supercharge their missile program, which ostensibly now the U.S. is okay with, per comments by President Trump. So I completely agree with you on that.
Sanctions failed. Operation Economic Fury, if you look at this and how it's played out, failed. What are the lessons from that?
Look, I think the key lesson from this entire episode, right, you go back to the sanctions under George W. Bush, Barack Obama, and then now under Trump in Operation Economic Fury and Operation Epic Fury, is that economic pressure is a powerful tool, but it's a limited one. And if you're trying to use economic pressure, for instance, just to curtail Iran's nuclear program, I actually think that was a viable goal, right? We had a deal on that in 2015. It's probable Trump could have even had a deal, earlier this year. If you're going for something more maximalist, like regime change, I think it's pretty unlikely, and you're going to wind up probably on a slippery slope to the use of military force.
Eddie, appreciate your time. As always, buddy, thank you. Eddie Fishman there of the Council on Foreign Relations and, of course, the author of, I think, the most timely book release I've ever seen, Choke Points, American Power in the Age of Economic Warfare. Coming up on the programme, Jonathan Krinsky of BTIG on why he's expecting additional downside risk for the AI trade. Plus, Yahira's back with us with your morning movers. Soaring prices coming back to bite some of the chip makers from New York City. You're watching Bloomberg TV. The volatility makes a comeback in the tech sector. We've got the Nasdaq down by 1.2%, the S&P 500 down by 0.5%, the small cap struggling as well. We're down by 0.6%. Lots of single name level stories to talk about. Many of them are in the tech sector. With your morning movers this morning, Yahira has more. Hey, Yahira.
Hi, John. After some wild swings this week, we are seeing the memory and chip trade faltering again this morning with names like Micron and AMD falling in the pre-market as investors grow increasingly worried about demand destruction after we heard from both Apple and Microsoft saying that they are hiking prices due to higher component costs. That is fueling concerns that slower spending may be ahead, and not helping sentiment is this report out that OpenAI may be considering delaying its IPO. Staying on the chip sector, we are seeing onsemi falling adding to losses, now down more than 14% in the pre-market after it announced an all-stock $6 billion deal to buy this company right here, Synaptics. Those shares rallying, but investors clearly not impressed by this transaction. Synaptics makes chips for things like phones, smartphones, and laptops. And what analysts are saying is that this takes onsemi further away from the AI data center story, which investors have been piling into. And we end on space with Rocket Lab. Those shares are rallying just up 1% in the pre-market after winning a new NASA launch contract, but it comes after this name was caught up in the space sell-off. It was down some 25% this week alone as investors start to question SpaceX and its valuation. John?
Starting to question everything this morning, at least. Yahara, thank you. Appreciate it. And I'll raise out this morning the president turning his attention to the home front.
And we have another one, a new market coming up, and that's called the lovely country of Iran. We're going to be taking some of their money and we'll spend it, and we're going to be buying wheat, soybeans, and corn, a lot of it. I am pro-farmer. We're never going to let you down. We're never letting the farmer down.
The president hosting farmers at the White House, maintaining Iranian funds will be used to buy U.S. goods. Trump also requesting another $11 billion in aid. Elsewhere, Samsung and SK Hynix ramping up spending. South Korean media reporting the chip makers are preparing to announce new investments worth hundreds of billions of dollars as soon as Monday. Despite a recent pullback, shares of Samsung and SK Hynix have more than doubled this year. And finally, OpenAI considering holding off an IPO until 2027. According to the New York Times, bankers are warning that recent volatility in tech stocks could hurt enthusiasm from investors. The CEO, Sam Altmann, reportedly pushing advisors to target a $1 trillion valuation.
I was thinking about this in the context of wider IPO markets because I was just in Berlin for Super Return, one of the biggest conferences for private capital, and I was asking people, is SpaceX a good thing for you or a bad thing for you as you look to IPO your companies? The resounding answer, because they love to be bullish, is, oh, this is a great thing. It's wonderful that this company can come to market and it's received so well by investors. That narrative obviously turns on its head if the IPO isn't a success. And that just shows the danger of having this mega hyped up IPO go before you, go before OpenAI, go before Anthropic. Timing is important for IPOs. And is the window now shut because of the volatility we're seeing?
We've all been following this race for capital. And by the way, it's not just happening in equity, it's happening in debt as well. And you've been tracking that too. It's starting to look like just recently more of a competition for capital. And that's why I think this story is important, that they are coming here late. And by late, I mean after Alphabet, after SpaceX, after SK Hynix, thinking about raising $30 billion. And we've also lost, I think, our ability to really internalize the size of these numbers. That the SK Hynix effort to raise $30 billion through US ADRs, as big as the Aramco IPO. And I've mentioned this a few times already this morning. I know I might sound like a broken record, but these are some of the biggest equity capital raises we have ever seen in the history of financial markets. Anthropic's still to come. No wonder the likes of OpenAI, who are on much shakier ground right now based on reports when it comes to financials and growth reports. They're on shakier ground. No wonder they're talking about postponing this IPO.
Part of the problem, though, is we've been spoiled by this narrative of there's cash on the sidelines. There's so much money that needs to be put to work. Credit spreads will never widen because there's so much money hunting from a home. And I think so many people took that to heart, including these companies who came to market. We are about to see a shift. The supply-demand dynamic is about to turn on its head because of the supply coming to market. Forget, just SK Hynix. What about SpaceX and the amount of shares that are going to be unlocked? These things are happening to the market, and I don't know if we've fully digested to exactly what you're saying, John, just the difference it makes to have more supply when we've been used to less companies going public and to be starved of that kind of equity issuance.
And to get trillions of buybacks on top of that as well. It's a real shift developing. Let's talk about tech. Stocks heading for a fifth straight day of losses as AI faces a fresh set of concerns. Jonathan Krinsky of BTIG writing the following: whether or not we rally in the short term, we continue to see medium-term downside risk for the tech AI trade. Jonathan joins us now for more. Jonathan, welcome to the program. You sit in a slightly different seat, technical, so let's focus on that. Why do you see this story turning the other way, from melt up maybe to melt down?
Hey, Jonathan. So I think, let's from a starting point, let's take a walk down memory lane. No pun intended, or pun intended. If we go back just 9 months ago, you had Bitcoin at 125,000. Sentiment was extremely bullish. It was the debasement trade. Retail was all in. calls for $1 million Bitcoin, and yet here we are 9 months later, and it's been cut in half. Go back to late October, you had the software sector at an all-time high. There was sentiment maybe was not as optimistic as it is on semis right now, but it was an all-time high. There was largely a moat considered around software, and within 3 months you had it down 30% and fears of AI wiping out the sector. And then you go to January, late January, when gold and silver were at all-time highs, calls for $10,000 gold. You kind of, again, had that debasement trade. You had to own gold, right? And then we saw about a 30 or 40% drawdown in precious metals in a matter of months. And then even most recently, just 6 weeks ago, the Mag 7 hit an all-time high. They were largely considered, kind of immune to the inflation trade or geopolitical risks. And yet here we are with hyperscalers down 10, 15, 20%, and fears of their CapEx spending going wild. So I think just from a history standpoint, I think investors should be aware that things can change quickly, and narrative follows price, not the other way around. So it may be hard for investors to see a bearish narrative on the semi memory trade, but also let's remember Nvidia, which is a semi, is down over the last 9 months. How many investors back in October would have thought Nvidia would trade lower with semis broadly doing what they're doing? So I think just history tells us things can change quickly.
Well, let's talk about what has been changing, and you noted a few of them, so let's unpack that. And I've picked out 2 names throughout this morning. You mentioned the Mag 7. Within that, Microsoft and Meta, those stocks in bear markets, Jonathan. And just this month alone, to have Microsoft down by more than 20%, to have Micron up by more than 20%, to have 40-point performance gaps between those 2 names when one company is doing all the spending and another company is receiving all of the capex. Jonathan, do you think that's sustainable? That's been a central question for this program this morning. Do you think it is?
We don't. And I think, again, leaving aside, where the money is flowing, the money in the stocks has obviously been flowing to a narrower and fewer part of the market, right? So even within semis, as we mentioned, Nvidia has started to roll over, but it's really those hyperscalers, Meta and Microsoft, that have been in lagging. But again, it wasn't that long ago that those were seen as, kind of the must-own names. So I think that the parabolic nature of these a lot of these names, specifically in memory, is typically unsustainable. And while it's gone much further than we would have imagined even just a couple weeks ago, the volume, if you look at the volume yesterday, it was a record notional volume for Micron, around $100 billion. That's one of the largest notional volume days ever in a lot of stocks. So I think, the run-up into Micron's earnings report received a lot of hype. And I think on the backside, maybe there's a little bit of sell the news over the coming weeks.
What about just the ownership structure of these stocks? Let's take Micron as an example. S3 data shows that active long ownership, so kind of more of the hedge funds you'd think about, the quote-unquote smart money, has been dropping. It's now at 16%, whereas passive holders are up about 27%. So a plurality of holders of Micron are passive holders of ETFs or passive mutual funds. What difference does it make for that to be the cohort in control of Micron?
I don't know that it makes a whole lot of difference. I mean, there's always going to be changes in ownership. The passive side, obviously, more on the ETF flows, and given the surge in leverage ETFs, that could also, money comes in when things go up, and obviously the leverage ETFs have the inverse on the way down. So I wouldn't look too closely at that. But I would say, again, look at the volume, look at the trading action. The other thing we highlighted recently for the broad-based semi-complex, you had 9 days in the last 90 calendar days when the semi-index was up 5% or more. The only 2 periods we've seen anything like that were in 2008, 2009, at the depths of the great financial crisis, and in 2000 to 2003. So again, these are historically moves you see in bear markets. We're seeing it, kind of in the tail end, what we think of this bull market, which suggests more of a blow-off type of trading action.
Well, then what do you make as we've seen kind of this rotation, this violent rotation within AI and within tech itself? You've seen value, cyclical, small caps, equal weighted measures. Those are outperforming. Jonathan, what do you look at to see whether that type of rotation is sustainable?
Yeah, I mean, that's actually one of the things we have been looking for is, as parts of the AI complex has rolled over, more so on the hyperscaler side right now. We've seen areas like financials, the regional banks hit new highs yesterday. Biotech's been doing well. Industrials, small cap industrials. And so there is a lot of rotation going on, which is still, we think where you want to look. So right now, the market is telling you it's rotational in nature. Money's still staying in equities. So there are places to go. It's just we think there are pockets that are a better risk reward at this point than some of the high-flying semi-names.
John, final question. It's well in your wheelhouse. At the opening bell, we're going to look for that break at a 50-day moving average. At the close yesterday, sitting right on top of it within a point. How important is that support?
Look, I mean, moving averages, we certainly look at. I think generally, from a trend perspective, you want to follow kind of more the slope of the moving average. So we'll look to see if the 20-day kind of turns down. But if you're talking the S&P again, it is going to be weighted by the tech trade. But look at the equal weight S&P and look at something like small cap value to get a sense of if there's more rotation below the surface.
Appreciate it, buddy. As always, thank you, Jonathan Krinsky there of BTIG. With equities under pressure this morning on the S&P, on the Nasdaq. That's the second time this morning, second time this hour we've heard someone say price sets narrative, not the other way around.
I feel like we're struggling for that narrative because of the price. I mean, we don't have a new Mag 7 yet. It's clear Mag 7's out. What's going to be our new fun rhyming or three-letter moniker that's going to take us forward?
Micron.
Yeah, MU. Perfect.
Right. Basically just that. Equity futures down by 0.5. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Ukrainian President Volodymyr Zelensky approving a 40-day influence operation to convince Russia to end the war. Zelensky did not give details of the plan, which he posted about on social media after receiving a briefing from the head of his security service on strikes against Russian targets. Microsoft raising prices for its current generation Xbox consoles again, citing a shortage of components. The company says memory and storage costs have risen more than 2.5 times and could double again by 2027. President Donald Trump is preparing to take his first trip on the presidential plane gifted by the Qatari government next week. Sources telling us here at Bloomberg the president will take the plane to an event in North Dakota July 1st. The jet is among the biggest foreign gifts ever given to the United States government. And that is your Bloomberg brief. John.
Vonnie, thank you. Thank you for the update. Up next on the programme, seeking stability from the labour market.
I do think, though, that the job market, in my mind, is stable without being good. The low hire, low fire environment. I think that's from business uncertainty.
Up next, we'll catch up with Brownback of BlackRock from New York City. This is Bloomberg Surveillance. Boeing this morning. Stock is up in a pre-market. Quick bounce, up by 0.6%. News just crossing moments ago. China Southern to buy Boeing planes for at least $3.62 billion US dollars. The stock responding to that, higher by close to 0.6%. That's Boeing. Broader market looks like this. Equity futures declining on the S&P 500 by 0.5, on the Nasdaq by 1.2. Bit of an offset developing in the bond market. We'll spend some time on fixed income in just a moment. 4 consecutive days of lower yields at the front end of the yield curve. We're down 3 basis points. Twos, sub 4.1%. Under surveillance this morning, seeking stability from the labour market.
I do think, though, that the job market, in my mind, is stable without being good. It's extremely weird that the layoff rate and the hiring rate would both be really low. That's the low hire, low fire environment. I think that's from business uncertainty.
So here's the latest this morning. Traders tempering expectations for an interest rate hike ahead of next week's payrolls report. Russ Brownback of BlackRock writing the labour market is softer than nominal GDP would suggest. Real wage growth is weak. Unemployment has not tightened meaningfully. Russ joins us now for more. Russ, good morning.
Hey, good morning.
A lot of people think we're setting the stage here for rate hikes. Would you take the other side of that?
Yeah, I think the bar is pretty high for the Fed to do anything from here. We've had this sort of surge in nominal GDP growth. The labor market has stabilized. We were kind of at peak job disruption fear. Actually, the day we entered the Iran conflict, remember February 27th was the day Block announced 40% layoffs, and we had 3 cuts priced into markets on that day. So today we've taken those out. The data has stabilized, and we've had resurgent growth, surprisingly, through the quarter. We really see that as sort of peaking right about now. So back half of the year, we see the inflation readings decelerating, and some of those influences that have been so heady are going to come off the boil. So the CapEx impulse, we think, decelerates just marginally, and the fiscal impulse is going to decelerate a little bit. So all of those things are data that will come to the Fed and allow them to sort of stand pat.
Good time to borrow or good time to lend?
It's the best time to lend. I've been doing it 35 years. You've got these unbelievably high risk-free real yields and then really, really good fundamentals underpinning credit quality. And so you can build these diversified portfolios. You know, there's been so much sort of consternation about bonds are costly and bonds are dangerous, when in fact the opposite is true. We've been in this income regime for the last 3 years, and the power of compounding very, very attractive real yields is the gift that keeps on giving. And we believe that's the regime for fixed income indefinitely.
There is a line of people who want to borrow, though, and spreads are really tight. So some people might be sitting here saying, why is it a good time to lend? Supply's picking up, spreads are already very, very tight. You've seen all these deals coming through on both the equity and the debt side. Why is it a good time to lend?
Supply's coming to the rescue of an imbalance we've had for years. Too much money, not enough yielding assets. So you think about the equity market, stock buybacks over and above IPOs. The share count in the equity market's been going down. Fixed income, there's $2.25 trillion of interest income that gets thrown off every year that needs to be reinvested. And gross issuance in credit has been high, but net issuance has been low. So now, if you're getting these bursts of supply, they're very welcome to a asset-starved market. And I think you're a long way from getting to the tipping point of moving into, the other side of the equilibrium.
I was going to say, I mean, at what point do you just mechanically see spreads widening because there is more supply coming to market?
So it's actually very interesting, Danny. If you look at the phenomenon so far this year, you have had these concentrated bursts of supply, and particularly related to the CapEx buildout. And that's where you're seeing the concession in markets. So overall public market credit indices are pinned at all-time tights. Where you're seeing the widening come along, we just deep dived this week in our strategy meeting. You're getting these new issue concessions in the places where there is this concentrated supply, but that's a gift to investors. So if these companies are coming along and deciding, if you're an investment grade rated company, and you're willing to borrow at levels that are below where your credit rating indicates that you might otherwise be needing to borrow, that's a gift to lenders. But if they can turn around and invest that and get a good return, everybody wins.
Well, there's also this question of crowding out because so much capital necessarily needs to go to work for this project of building out AI infrastructure. I was having this conversation with Scott Goodwin of Diameter, who said that he's starting to notice very slightly, but picking up in other industries that aren't tech related because all the money is getting funneled to them. Do you think that for maybe more cyclical type industries or ones that, again, don't have anything to do with the AI build out, that their spreads were widened because they're kind of being ignored by the market?
So I don't. And, we do investment committee meetings every day. And what I see still is pockets of irrational behavior where people are crowding into lending at levels that aren't necessarily where there's intrinsic value. So I think the evidence is still very much in favor of the idea that there's a surplus of capital. You have seen some re-rating of illiquid assets in general. And as I said, if it's data center finance related, if it's CapEx related, and the supply is very concentrated, the concession's been wider. And so you just need a very discerning lens in this environment to be a lender. But again, the intrinsic value is there.
So bottom line, you think yield is attractive right now. All-in yield's high. And we've talked about where that's coming from. 85% of it's coming from the risk-free asset. How risk-free is the risk-free asset right now?
I find everything's in equilibrium. So risk-free rates are high, largely because real yields are high today. That's a reflection of very, very solid nominal growth. Credit spreads are narrow today, but that's reflecting the same very strong growth that underpins credit fundamentals. And the key is diversification, because there is dispersion. It is an uneven economy. And so you want to be very careful how you build the portfolio. But diversification on top of that very high risk-free yield curve is this incredible Sharpe ratio trade. And, it's the compounding. I mean, you can feel the compounding as we're sitting here talking. The income is just ticking up, and that's the regime that we're in. And as I said, we think it's indefinite.
Can we finish on the dispersion? Are there parts of this economy that you are less excited about, that you wouldn't be interested in lending to? Now, of course, I say that knowing that BlackRock is a massive shop and lends to almost everything, but just thinking about where you want to be and where you don't want to be.
So, you know, look, it's an uneven economy. You have the rate-sensitive sectors of the economy that are suffering today, and whether that's small businesses, whether it's anything in the residential real estate market, you know, whether it's in sort of the credit card or auto loan securitizations. If you look at the bottom of the capital stack there, you start to see delinquencies move up. So there are pockets of stress in the economy. Again, if you can get paid the right price for those parts of the market, that's fine. But you just need that discerning lens as you're constructing portfolios.
How does the Federal Reserve calibrate policy to adjust to that when you have these areas of weakness in household balance sheets, but you still see all this strength in corporate balance sheets?
Yeah, it's tricky because their policy tools are pretty blunt. And, you know, when you think about the things driving inflation today, those aren't the things that Fed policy is designed to sort of get at. All the more reason for committees to evaluate what the protocol, what the reaction function of the central bank is. I'm really excited about what the modern toolkit
You're a
might look
task force fan.
Absolutely. You know, listen, we disrupt ourselves in our business every quarter to make sure we don't have recency bias. We aren't just doing things a certain way because that's the way they've always been done. At a time when there's profound innovation, when there's lack of visibility about where the world's going to be in 6 months or 12 months, the toolkit should be reinvented. The data set should be reinvented. And I'm really heartened that that's the progression.
I was tempted just to ask you if you like the dot plot or press conferences, but you said the toolkit. What do you think they're going to change in the toolkit?
So I think they need to be very open-minded at a time when things have changed. So, you know, whether it's, you know, we look at all the different proprietary data sources. We've been building and compounding that toolkit forever. You know, we had a debate internally this week. Somebody said, oh, the Taylor rule says that the Fed should be tightening. The two most important inputs in the Taylor rule are the economy's growth potential and R star. I don't think anybody has any idea that's credible exactly what those things are today. So what we need to do is go in and investigate, you know, what the right data points are and then what the right models are for a modern economy. And I'm really excited to see where that goes.
Russ, excited to catch up with you, sir. Who's excited about this fixed income market right now? It's good to see you, buddy. Thank you.
Thanks,
Russ Brownback there of BlackRock. Coming up next on the programme, we'll catch up with Marvin Lowe of State Street, Vivek Arya of Bank of America, Greg Daco of EY-Parthenon, and Ulrike Hoffmann-Burchardi of UBS. The third hour of Bloomberg Surveillance is just around the corner, with equity futures on the S&P 500 declining by 0.6 and the Nasdaq down by 1.35.
The technology revolution will continue.
It's just rapid fire movement of money.
The red lights would start flashing if it felt like there was blind euphoria. We've been on this broadening out theme for a long time.
The market's going to broaden out a little bit.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now in your price action. Your scores look like this. Equity futures down again by 0.5 on the S&P, on the Nasdaq down by 1.29, down by 0.6 on the Russell. In the bond market, a bit of a rally again at the front end of the curve for a fourth consecutive session, down by 3 basis points. The 2-year just short of 4.1%. 10s anchored around 440, down from around 450. Looking ahead to next week, the main event is Thursday. Holiday shortened week next week. It's payrolls Thursday. And so far, the data has been pretty decent, which is why this Federal Reserve has become increasingly focused on hiking interest rates.
It's the refrain of we need to get to 2%. We heard it from Williams yesterday, Goolsbee talked about, and we've even heard it from Kevin Warsh from the chair, and that allowed the market to interpret it as something hawkish. But it is still some stability we're seeing. PCE, maybe not comfortable, but not uncomfortable. And it's allowed for a market, while we deal with the equity market volatility, as we try to figure out how to trade the AI trade, you can see some more calm in both fixed income. And now that same calm seems to be returning to oil markets too.
Don't have any calm whatsoever in the tech trade, at least this morning. Overnight in Asia and South Korea, tons of volatility. 4 days, no gains on the S&P 500. Monday, Tuesday, Wednesday, Thursday. It looks like it's about to become day 5. Unlike yesterday, Micron this morning is trading lower, and Micron at the epicenter of a massive conversation in technology right now. Their 85% margins becoming a bigger problem for everybody else.
It's a huge problem. And I also think about other things. Okay, so we decided data centers are really hot, so let's buy a bunch of optics stocks. If all of a sudden these hyperscalers are spending huge amounts of their budget on memory, what's left over for everything else? This is damaging for many companies that are surrounding the AI trade because Micron can command 86% margins. But we also have to ask, does it mean that Micron's not cyclical anymore? It's priced at 8 times forward earnings. It's like nothing. And it's priced that way because we've decided this thing is cyclical. Are we going to start to change our minds? Is something going to shift? And that does mean further gains from Micron, which we're obviously not seeing today.
Equity futures shifted this morning. We're down by more than 1%. Micron, that's negative between 4 and 5 percentage points in the pre-market. Coming up this hour, we'll catch up with Marvin Lowe of State Street on another round of tech volatility. Vivek Arya of Bank of America raising his forecast for the chip sector. Greg Daco of EY-Parthenon on how AI is keeping inflation above target. We begin this hour with stocks inching lower following renewed selling in tech. Marvin Lowe of State Street is blaming the Fed. Tighter liquidity is likely behind recent equity volatility, which has been driven by Fed chair wash uncertainty. This is loosening, and we think that risk should stabilise. Marvin joins us now for more. Marvin, welcome to the programme. I just want to build on that. Just how much of these jitters in the equity market lay at the feet of the Fed chair and maybe not the likes of Micron?
Well, I mean, for sure, we've had an incredible run in a lot of these stocks, and, they're rich, they're over-owned, and there's a natural amount of flow and diversification that goes along with it. In terms of what we're hearing from the Fed, in a lot of ways, it's a position of strength. A lot of these conversations about whether they hike or whether it's an extended period of holding is really a function of the growth story being much better than we expected at the beginning of this year. In terms of the uncertainty that potentially is making its way into the market, which is a little bit more concerning to me, is on the balance sheet policy side of things. And I think that the Fed balance sheet and the amount of liquidity that it's been able to provide in the market has been a tailwind for risk assets, really for the last few years. And a significant change in that policy is something that, we should watch as investors.
Marvin, what would a significant change in that policy even look like over the next several months?
Yeah. I mean, for sure, if we wind up hearing from the Fed that they want to shrink the balance sheet below the levels that we got to at the end of last year, if you will, that created a little bit of volatility within the funding market, and then stopped the QT process and ultimately restarted some of the asset purchases on the Treasury bill side of things. That is something that we've seen have a negative impact on risk assets. It really wasn't that tight of an amount of liquidity that caused that volatility within the funding world. If we significantly look back towards, maybe different regimes, thinking about what the balance sheet might have looked like near the beginning of the GFC, that's a significant change in the amount of liquidity that's in the system.
When it comes to capital market liquidity, Marvin, Ludo Sobran, the Allianz CEO, was talking to the FT and basically made this argument that all of this issuance that we've seen, whether it be on the equity side from SpaceX or on the bond market side, that for him it's a sign that we've shifted from a healthy boom to a stretch boom, now into bubble territory. Do you get red flags from all of the issuance coming into the market?
You know what? It certainly is a very important marker. The amount of capital, the demand for the amount of capital is something in my mind that requires a higher interest rate and ultimately robust liquidity in order to continue. And the fact that spending is so important to the GDP story, which is kind of really where U.S. exceptionalism is rising above. You've got a bunch of Jenga blocks, if you will. It's not as if we're seeing those blocks being pulled out in wholesale manner. But certainly there is a bit more tightness with the uncertainty that we're hearing from a new Fed that really wants to look at everything. And that's not necessarily a bad thing. But there's a period of uncertainty as they kind of figure out where they want to settle.
In the meantime, Marvin, can we just discount oil as an important driver of this economy? We saw some volatility, but we're back to levels that we hadn't seen since before the start of the war. Has oil kind of lost its punch and therefore lost its punch for a driver of this Treasury market?
Yeah, I mean, for the moment, for sure. I think that inflation expectations have probably gotten a little bit ahead of itself in terms of tracking that decline in oil prices. But it has had a limited impact, certainly in terms of the pass-through. It really hasn't affected spending at all, and it's allowed kind of this growth story to be the main reason that we're thinking about a Fed that is leaning towards tightening.
Marvin, it didn't hit spending on the way up. Does it support spending on the way down?
I think so. I think that's an underappreciated part of this discussion. Gas prices below $4 is just going to put a few more dollars into a lot of people's pockets.
This is the Torsten Slot camp. Just how hot do you think this economy will be as we work our way through summer?
It has surprised to the upside, really for the last several quarters. I think ultimately it can continue to do that as we go through the summer.
Even so, Marvin, so you have consumers who are spending, but they're extremely unsatisfied. They're extremely upset that inflation is still a problem. And the way that you're seeing that play out is not through spending, it's through the politics of the moment. I mean, New York City's elections are a great example of that. If you do get more policy that kind of follows this populist bend, if we're talking about the government taking stakes in AI policy, how are you thinking about that filtering through to the investment decisions you make?
That's all of the populism that we're seeing is inflationary in my mind. And I really do push back on the view that inflation expectations are automatically on a downward slope because oil prices have come down. I do think that you see that pressure kind of building across wages, building across rents. It does wind up creating an inflationary type of environment that's kind of hard to pull back.
So what does the Fed do in all of this then, Marvin? It's some clear inflation drivers that you're pointing to. Not necessarily seeing anyone condoning hikes on the Fed, but they certainly at least don't sound like they're ready to cut anytime soon.
Yeah, I mean, I think that they need to maintain that tightening bias. So far, the market has voted with confidence in terms of pulling down longer-term yields. Remember, we've been talking about it for the last 6 to 9 months, how unanchored the long end of the curve was because we were concerned that the Fed wasn't going to really get a handle on that inflation. Again, some positives that came out of the FOMC meeting last week was that the long end is behaving. Investors do believe in the inflation fighting will of the Fed. And they need to continue to do that because that long-term yield is so important to really all of the growth within this economy.
Marvin, good to see you. It always is. Thank you, buddy.
Thank you.
Marvin Lowe there of State Street, breaking it down. And please, you brought up the politics. You saw the headlines overnight, I'm sure, about stabilising rents in this city and keeping everything unchanged.
Yeah, I mean, there is some real discontent. And in the past, we've seen that maybe move people more to the right. This time around, it's moving people more to the left. It shows up in NIMBYism of people not wanting data centers in their backyard, about rent stabilization. There is this real growing force, and it's hard to really extrapolate what's happening in New York to the entirety of the world because it's a bit of a bubble here. But you do feel that discontent playing out in policy.
Which is why you see the populists on the right and the left agree on certain economic issues.
The kind of horseshoe of politics.
Bending together. You see interest rate costs on credit cards. That's how we started the year. We were having this conversation around the table yesterday. That's how we started the year. Getting Wall Street at the housing market. All that stuff is coming back to the surface once again.
But I guess the question will have to be how much of it is lip service and actual policy. You look at the housing bill that was just passed by the Senate. They were trying to curtail institutional investment in housing, but there were so many caveats that ultimately it doesn't make that much of a difference. But then they can go to their constituents and say, look, we passed this thing to get institutional owners out of single-family housing.
The conversation building up again going into the midterms later this year. Equity futures, if you're just joining us, welcome to the programme. On the back foot this morning, we're down by 0.4% on the S&P, down by around 1% through much of this morning on the Nasdaq. With an update on stories worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. OpenAI is leaning towards holding off on an IPO until next year. The New York Times reporting bankers caution that recent volatility in tech stocks could dampen enthusiasm from retail investors for OpenAI's offering. Microsoft raising prices for its current generation Xbox consoles again, citing a shortage of components. The company says memory and storage costs have risen more than 2.5 times and could double again by 2027. In sports, Ecuador mounted a bold comeback to upset Germany 2-1 in the final match of group play. It's their first win of the World Cup and secures a berth into the knockout stage. Elsewhere, the Ivory Coast beating Curacao 2-0 to make the knockout stage for the first time in history. And that is your Bloomberg Brief. John.
Some big games later as well, Vonnie. Thank you. France and Norway, Uruguay, Spain later on this afternoon. Two big games to watch.
Yeah, it's been such a good summer for sports.
It's been pretty cool, hasn't it?
It's been really cool. This weekend, some good games. England, Panama.
You'll be there
for that one. I'll be there.
Right.
I've got my England kit ready.
Oh, have you?
Yeah. It's like an old school Beckham one. It's pretty cool.
Nice.
But it looks wrong when I speak because then this American accent comes out and they're like, oh.
Doesn't matter. I'm sure you've got an English accent in there somewhere.
Oh no,
you can make it
No,
work.
no, we don't. We
don't have to practice here. Bramo did that once. It didn't sound too good.
Yeah, I'm learning from her mistakes, John.
Yeah, we won't repeat that mistake. Up next on the programme, the Morning Calls Plus, we'll catch up with Vivek Arya of Bank of America with a bullish outlook for chip stocks. We'll have that conversation in just a moment, with equity futures negative by 0.3% on the S&P, recovering just a touch. On the Nasdaq, we're down by 1 percentage point.
When you look at OpenAI and the frenzy around it, it doesn't feel as much like an analyst reading, SK Hynix reports as it does the GameStop glory days. And so I think that they were depending on that frenzy to be able to give them a valuation that doesn't really make sense when you look at the numbers.
That was Sarah Kunst of Cleo Capital weighing in on the potential delay to the OpenAI IPO. We'll catch up with Ed Ludlam on that in just a moment. Let's check out the price action together on the S&P 500, declining by 1/3%, erasing some of the losses this morning as we get closer to the opening bell, 1 hour and 15 minutes away. On the Nasdaq 100 this morning, down by around 1 percentage point. On the week so far, down Monday, Tuesday, Wednesday, Thursday, 4 days, no gains on the S&P 500. You make it day 5, and that's the longest such streak of the year so far. That's the equity picture. Here's the bond market story. 2s, 10s and 30s. 2s yields declining by 3 basis points. Once again this morning, for a fourth session, we're down to about 4.1% on a 2-year yield, the longest such run going back to the start of the year, the month of January, I believe. Encouraged by this move in crude, we talked about the disconnect between the return trip we've had in Brent and still the elevated yields at the front end of the curve, maybe recoupling somewhat. Down 3% this morning, 72 on Brent, 69 on WTI. Just bear in mind, we've wiped out the wartime rally on crude, and yet still, yields at the front end of the yield curve are still some 70 basis points higher now than they were at the end of February before that war started. That's the cross-asset picture this morning in financial markets. Let's get you some morning calls. First up, KeyBank downgrading Nike to sector weight, saying the company's turnaround is taking longer to materialize than expected. Your second call from TD Cowen, downgrading onsemi to hold, saying its deal to acquire Synaptics adds complexity to an already complicated model. That stock is down in the pre-market by 13%. And finally, DZ Bank upgrading Qualcomm to buy, reflecting growing confidence in a chip maker's expansion. That name is still lower by 1.6%. Let's stick with tech. OpenAI considering holding off on an IPO until 27. According to the New York Times, bankers are warning recent volatility in tech stocks could hurt enthusiasm, while the CEO, Sam Altmann, pushes for a $1 trillion valuation. Bloomberg's Ed Ludlow has more. Ed, good morning, buddy. There's a long list of companies looking to do the same thing, and this one was top of the pile. What do you make of the potential, and I stress potential, delay?
Yeah, potential delay. I mean, the New York Times report cites the concern from OpenAI and its advisors of commanding a valuation they think is fair in this environment. The idea that OpenAI would go in 2027 as opposed to the end of this year is kind of consistent with what we've been hearing anyway. And on June 8th, when they disclosed their confidential filing, they basically said, even though we've done this, it will be some time. We've not set a date, in part because there are lots of things the company wants to do that are easier to do as a private company than being in a public company. But I think what I hear a lot at the moment is there's a level of comfort in letting Anthropic go first, and that Anthropic is moving. You know, it's getting the mechanism in place to do this. There's also a lot of cautionary tale, both not just in the equity, but in the bond story of what's happened with SpaceX in recent days, of pulling the trigger quickly.
Ed, are they also just late? This is the question we've asked, whether this is an OpenAI issue or just a broader capital market story, that we had Alphabet get out early, just ahead of SpaceX with that upsized monster equity capital raise. Then we had the biggest IPO we've ever seen with SpaceX. And then this week, Danny and I were talking about this earlier this morning, SK Hynix looking to raise $30 billion through US ADRs. That alone is one of the biggest capital raises we've ever seen in US capital markets, Ed. Are they looking at that and saying, you know what, it's too much too quickly? On top of that, you've got the lockup, the staggered lockup of SpaceX just rolling out over the next 6 months or so that they've got to contend with too.
That chronology is spot on. And, we've been talking about it for a month, literally in that order, the sequence of events, and the idea that there's a finite pool of capital. The one thing that is slightly different with OpenAI with respect to which order they go in is look at the commonality on the cap table of Anthropic and OpenAI. There are lots of investors ranging from mutual funds to the sovereigns that have decided to back both at different points in recent history, and maybe deciding, is there room in the world for 2 horses or just one? SpaceX included in that race as well. And then who the potential, sort of cornerstone investors would be in an IPO. But again, just reflecting on what OpenAI has said on the record, which is very limited, there are lots of things that you can do as a private company you may be restricted in doing as a public company. And noting also that Anthropic's kind of overtaken them from a revenue run rate perspective or traction in enterprise deals, etc. That factors in too.
Ed, before you go, down 5% on Micron, wanted to squeeze this in. It's been the conversation of the morning right here on Bloomberg Surveillance, that their 85%, 86% margins are becoming everybody else's problem. Sustainability is the word. Sustainability is the question, Ed. What's the response you're getting?
Yeah. Historically, they do not maintain margins at elevated levels throughout a memory cycle. The question is whether this is cyclical or that the fundamental structure of the memory chip market has changed for good. I heard what you guys were talking about earlier why are we also investing in optics? Why are there supply constraints everywhere? It's really simple. GPU-based architectures dominate data centers. For every one Nvidia Blackwell, there are 8 corresponding stacks of high bandwidth memory. It's just logic that if what we're hearing from Nvidia is true, the continued investment in Nvidia GPU-based systems, and the growth is like that, an upward curve, then supply will remain tight for a long time on the memory side. And because of the pricing power that Micron has and others, and the demand that the data center have with their CapEx power, that's where they go. And it's why Apple had to raise prices on the consumer electronics side, and Xbox followed suit.
Ed, it's good to see you. Looking forward to the programme. 3 hours away. Bloomberg Technology, hosted by Ed Ludlow. Vivek Arya of Bank of America staying bullish on semis, raising his forecast for the chip sector, expecting the market to reach $2.7 trillion by 2030. He writes the AI industry moving to addressing structural and physical constraints from having to defend return on investment before. Memory chip shortages and price inflation remain the critical moving pieces. Vivek joins us now for more. Vivek, welcome. We've been asking how much longer is the runway. The response we're getting from a lot of people is longer than you think. What's your response?
Good morning. We think that the AI infrastructure cycle could last at least through the end of this decade. I think we are only about a third of the way through. And, there is still a lot of adoption ahead when it comes to enterprises, when it comes to consumers. Yes, there has been a lot of deployment of this infrastructure initially by the hyperscalers, but I think we are very early in the adoption of these services and applications by enterprises and consumers on premise. There's a lot of deployment that different countries and states and regions need to do to be self-sufficient. So, no, we are extremely bullish. And I think that means very good things across the semiconductor supply chain, whether one looks at computing companies, whether one looks at networking, optics, memory. And, these kind of deployments are never a straight line. There are going to be periods of digestion in between. But I think that despite that volatility, I do think the cycle can last till the end of the decade.
Vivek, on that cycle, I have the same question for you that John was just discussing with Ed, that these stocks, these semiconductors go through boom and bust historically. Is this time different?
Yeah, they do go through boom and bust cycles, and there is there is a scenario where between now and till the end of the decade there is a year where there is a period of absorption. But I would say that is part of any cyclical industry. What we have to question though is that do we believe that the deployment of this AI infrastructure is important, and that is there enough of monetization and funding and the returns that these hyperscalers are getting? And our assumption is absolutely yes. Look at the growth rates that the top search company, the top web services company, they are getting. Their growth rates have accelerated to their fastest level in the last 3 or 4 years. If you look at the largest social company out there with 3 billion plus subscribers, it is growing 20 to 30% a year. How does a company with 3 billion subscribers grow 20 or 30% a year? The only way for it to do that is to extract more value from every user. And AI is a critical tool to do that. That is why we are so bullish, because I think there is a secular theme. But of course, within any secular theme, there could be periods of digestion and in between. And if you look at the growth rates for the end customers that are anywhere between 20 to 30% on an average, the semiconductor industry is not able to create capacity that quickly. It takes years, billions of dollars to add new manufacturing fabs. There's a lot of specialization required. And so I think the supply-demand imbalance can last for a while. And then the final point I would make there is, the top 3 semiconductor companies that I cover, Nvidia, Broadcom, and Micron, they're all trading at below market multiples. So it is different this time, because I do think the cycle can last longer, and because I do think the valuations make a lot more sense this time around.
Vivek, always good to catch up. Appreciate your time. Vivek Arya there of Bank of America. That final point, such an odd situation to see a move like the one we have on Micron up by more than 200% year to date. And we can sit here and say the stock is still cheap. Yeah. Just crazy how much earnings have picked up and how quickly they have done.
I was going to say, their last earnings, even though they rallied 16%, you saw price to earnings ratios come down because their earnings were still strong. This thing is still trading under 9 times forward earnings. If you believe that it's a boom and bust cycle, that's reasonable. If you think this time's different, as Vivek does, that's pretty cheap.
Micron, lower this morning by around 5%, up on the year exponentially. Coming up on the programme, we'll catch up with Greg Daco of EY-Parthenon and how AI spending is driving inflation. Plus, Yahira, has your morning movers fears of a delayed public offering from OpenAI weighing on some cloud stocks this morning? We are on track for the wrong kind of clean sweep every single day this week. On track, at least, for a day without gains. On the S&P 500 this morning, we're down by 0.4. On the Nasdaq, we're down by 1 full percentage point. We haven't had a run like that all year. On the S&P on the back foot, likewise on the Russell, we're negative by 0.5. In the bond market, things getting better, firming up at the front end of the yield curve when things were getting away from the Federal Reserve. The 2-year yield is still well above the policy rate of the Federal Reserve, but it's certainly not as above as it was. We were looking at 420 only a few days ago. We're back down to about 410 on twos. We're down 2 basis points. Setting the tone for this next week will be payrolls Thursday. The firming up of the unemployment story, the labour market picture, has just allowed this Fed to focus more on the other side of the mandate, inflation, things like that. You just wonder if it flips back if we get a bit of weakness just next week.
I mean, it would have to, also because on the inflation side of things, now oil has started to come down. So that also gives them a bit of time to play for. I would also just make the comment that this will probably ruin a lot of people's long weekends. Ian Lingen out with a note saying July 10th would have been fine. Yeah, you didn't have to do this on Thursday.
As if 4 days isn't enough, right?
Yeah,
right.
Exactly.
We have to hang out for payrolls too.
Yeah, of course.
What did you want, like 3.5? Is that what you wanted next week to be?
I think every week should be 3.5. No, we can get all work done.
250 fantastic years of this country's history, and we should have a 3-day week, of course.
Yeah, I think in this country's history, we used to have a 6-day week. So, I mean, I'll take 5.
Or 7.
Or yeah,
given
or
the work ethic of the original settlers.
That's a very good point. Weekends were probably not a thing.
Yes, we look lazy, that's for sure. 1 hour away from the cash open with your morning movers. Yahira has more. Hey, Yahira.
Hi, John. We're seeing the impact from that report that OpenAI may be delaying its IPO until 2027. We saw the news hit SoftBank overnight in Japan, that stock plunging some 13%. And now we wake up to CoreWeave and Oracle both lower in the pre-market because both these names have a lot riding on this listing. Oracle has a $300 billion deal to build OpenAI's data centers, while CoreWeave has a cloud partnership worth up to $22 billion. And that is not helping sentiment around the chip and memory trade. We are seeing names like Micron and AMD falling in the pre-market. Along with this reason, investors growing increasingly worried about demand destruction after we heard from Apple and Microsoft that they are hiking prices on their products because the components are getting way too pricey. So that is fueling concerns about spending eventually slowing at one point. And we end on the semiconductor trade. Not a good day to announce a deal if you're a chip maker, but that's the situation that onsemi is in. Shares are plunging 13.6% after it agreed to buy this company here, Synaptics, in a $6 billion all-stock deal. But investors clearly not convinced, since Synaptics makes chips that go into things like laptops and smartphones. And what analysts are saying is that this takes onsemi away from that AI data center story, which is much more lucrative. John?
Harry, thank you. Thanks for the update this morning. Some of the move is going into the opening bell in about 58 minutes' time. Inflationary pressures remaining elevated. PCE data posting a 4 handle for the first time in 3 years. Greg Daco of EY-Parthenon writing, the AI investment boom is contributing to price pressures across tech-related inputs. As a result, headline inflation should moderate, but core inflation is likely to remain uncomfortably firm above the Fed's 2% target. Greg joins us now for more. Greg, welcome back to the show. Let's talk about that. If we are uncomfortably above the 2% target, does the Fed have a role here? Most people would say yes, but if they hike interest rates, what kind of a difference does it make?
Well, I think we have to be careful as to where the pressures are coming from. What I've been arguing is that a lot of the inflationary pressures that we're seeing today are coming from the supply side. And there's really not much that the Fed can do in this environment. If you look at the plus and minuses in terms of inflation drivers, on the downside, you have lower energy prices now that will feed into lower gas prices over the second half of the year. You still have some disinflation in the housing market, but that's likely to come to an end. And then you have the labor market, which is disinflationary because wage growth adjusted for inflation is actually in contraction territory. Some of the supply pressures are coming on the plus side. You're seeing, as you were talking about just a minute ago, higher price pressures on the computer front, on the memory storage front. That's passing from producer prices onto consumer prices. You're also seeing some lingering effects from tariffs, and you are seeing some lingering effects in terms of transportation costs and production costs from higher energy costs still feeding into the supply chain. So the Fed can't really do much about those supply shocks. And I think, in my opinion, the Fed's likely to wait this out rather than tighten monetary policy as it currently stands.
Oh, Greg, let's build some life into that. I've heard from Deutsche Bank, BNP, Bank of America, they're all expecting hikes. We caught up with BofA yesterday, who think they could go as soon as July. What's going to give them the time, the luxury of waiting?
I think there's a little bit of a bias towards looking at other central banks and how they've reacted to this to this environment where inflation has risen. You've seen the Bank of Canada, you've seen the ECB tighten. The ECB is still talking about further tightening. But where did they start? They started at a policy rate that was close to neutral. We're still at a marginally restrictive monetary policy stance. And as I was saying, you're not seeing the typical inflationary forces from the labor market. In my opinion, and this is something that the market does not necessarily seem to be in agreement with, but the labor market is not inflationary. If anything, it's disinflationary. Yes, we've seen job growth stabilize. Yes, we have a low unemployment rate. But if you look at wage growth, which is a key gauge in terms of labor market health, that is declining when you adjust for inflation. And let's not forget, when you and I go to the grocery store, we don't really care about the unemployment rate. We care about the income we have in our pocket, and that income is under pressure from higher inflation. That's gradually eroding spending power. So I think the Fed is going to be very cautious about tightening in this environment where some of these supply pressures are leading to higher inflation, but they're also eroding demand, final demand, and that's an area of caution.
Greg, why aren't we seeing more of that than show up in consumer spending? Why have those figures remained really resilient?
I'll pivot that actually to the other side. You know, there was a lot of talk of massive fiscal stimulus being injected into the economy from the One Big Beautiful Bill, larger tax refunds fueling spending. But look at consumer spending growth in the first quarter, very weak, below 1% on an annualized basis. Look at the trend in terms of consumer spending adjusted for inflation, around 2%. But income, I come back to this, is still flat to slightly negative when you adjust for inflation and taxes. So that is really what I'm very keenly focused on. Yes, consumers can spend with wealth, and there has been greater wealth accumulation. They can spend with credit, they can spend with savings, but we have to be conscious that these are finite resources. If you look on the longer horizon, we're going to be in an environment where that pressure, that income squeeze, is going to lead to slower spending growth. I'm not talking about a recession or a contraction. I'm talking about more conservative discretionary spending happening. And while the World Cup may provide a bit of that lift in June and July, we have to be conscious that there's going to be this cap on spending momentum as we navigate through the rest of 2026.
Greg, though, how much of this market is doing the heavy lifting from that? We started the show speaking with Cam Dawson, who talked about how great the wealth effect is at this moment. How much of that is currently tied to the spending we're seeing, and what does that mean if you do start to get market declines?
I think we are seeing some of that wealth effect feed into consumer spending, especially on the services side. You see a little bit less of it on the retail side, and that's not surprising because a lot of the higher income spending tends to go towards spending on services, leisure activity, travel activity. So that's where you start to see more of that wealth effect. But let's not forget, we're also in an environment where if you have that income squeeze, which is the main pillar to consumer spending activity for the majority, the 99% of us, then in that environment, you're not necessarily going to see an acceleration in consumer spending momentum. You're going to see a cap on consumer spending growth. So I would anticipate that for the rest of the year, we're going to be in that 1.5% to 2% range when it comes to consumer spending growth, and that's going to limit the overall pace of economic activity. That's why I'm conscious and cautious about calling the Fed to hike in this environment, because again, I'm not seeing the types of mismatches between demand and supply that would force the Fed to tighten monetary policy in an effort to curb demand and curb inflationary pressures.
In the meantime, Greg, do you have to communicate hawkishly for the following reason, that it feels like things are a little lose-lose right now? Because let's say the Fed takes your way of thinking about things and talks about it publicly. Fed Chair Walsh comes out and says, there's nothing we can do about this. I get it. It's above target, but we don't have a role here. What would happen to inflation expectations if we saw that kind of reaction from the Fed?
Yeah, I mean, that's a great question. I think you have to communicate. That's number one. I'm a little bit skeptical of this notion that the Fed will be communicating less, will be less transparent about its intentions in terms of monetary policy, because that leaves markets and investors to try and interpret what the Fed is going to do. That's going to lead to more volatility. So number one, you have to communicate and be clear as to your reaction function. Number two, yes, you do need to stay with that hawkish stance. Gone is the easing bias. That's a good thing. But you have to communicate the possibility that you will raise interest rates should you see, one, more inflation persistence coming from the demand side of the equation, two, potentially a rise in inflation expectations, and three, potentially a rise in wages. We're not seeing that. We're seeing wage growth continue to ease lower and real wage growth, as I mentioned, into negative territory. But communication, John, is the most important thing in this environment.
Greg, appreciate your time. As always, buddy, thank you. Greg Daco there of EY-Parthenon on this Federal Reserve. It's early days. I don't want to be too critical of an institution that's got new leadership, and we've only had one news conference with the Fed Chair, Kevin Walsh. But he did fail to articulate a reaction function for this Federal Reserve. And that's where some of the criticism has come from over the last week, particularly from the likes of Neil Dutta over at Renmac and others.
For sure. I think Greg's point is an interesting one, that you have to communicate because you don't want it to leave it just to the markets to decide the fate of financial conditions. You didn't really get that sense, though, from Chair Walsh. And I wonder if it does take some big market test for him to step in and issue something that maybe looks like forward guidance in order to get the rein back from what financial conditions are doing.
Not seeing that test this morning. We've got yields lower at the front end of the curve. We're down by about 2 basis points to 4.1%. 10 stable, around 439. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Iran striking a cargo ship in the Strait of Hormuz. Multiple outlets reporting Tehran was behind the first reported attack since the interim peace deal between the US and Iran went into effect last week. A policy win for New York City Mayor Zoran Mamdani. The city's Rent Guidelines Board voting to freeze rents for about 1 million stabilized apartments. The decision applies to both 1- and 2-year leases. It's the first time rents for longer-term agreements have been frozen. The US finishing its World Cup group stage with a 3-2 loss to Turkey. The Americans already securing a spot in the knockout stage. Team US will face Bosnia-Herzegovina in the round of 32 on July 1st. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Ulrike Hoffmann-Burchardi of UBS, saying the AI rally has more room to run. From New York City, you're watching Bloomberg TV.
I think the only reason why Micron's able to post 830% earnings growth in the year of 2026 is because the hyperscalers are willing to reach very deep into their pockets. And I think the big question is how much more upside is there to hyperscaler capex spending?
Cam Dawson, NewEdge Wealth, on the programme earlier on this morning, just a few hours ago. And that was the central question for this programme this morning. The monster wealth transfer that you're seeing from the hyperscalers to the capex takers, the chip makers right now. And really capturing that story through this month so far is a 20% plus decline in Microsoft and a 20 plus rally, percentage point rally, for the likes of Micron. That gap really explains the story of the moment in this market.
And what does it mean for market leadership? Because those big cap tech stocks, they had been like our safety blanket for the market, this nice little corner to retreat to. We had Mag 7. Now we don't really have anything. It is maybe just Micron. So we're trying to figure out what market leadership actually looks like. And that's always a very messy process. And it feels like we're living through it right now.
85, 86% margins, and it's becoming everybody else's problem.
It is, whether
Microsoft,
you're Apple,
yeah.
Exactly. I mean, you can have on one day the same story send Micron higher by 16% and Apple down by 6%.
Today's an odd one. I said this a little bit earlier. It's slightly confusing. So their margin's a problem for everybody else, which becomes a problem for them at the same time. That makes sense this morning.
Or it's just South Korea is doing weird things, and the ETFs there are doing strange things. Too much leverage. Maybe this is deleveraging, not a fundamental story. You can kind of, pick your adventure what you want.
We'll spend some time unpacking that in the next 5 minutes or so. Let's turn to the market. Equity futures on the S&P 500. Futures look like this, pulling back by 0.5% on the S&P. On the Nasdaq 100, we are down by 1.3. We've talked about things firming up at the front end of the yield curve. Twos are down again for a fourth consecutive session. Yields lower. We're lower by 2 basis points to a break of 4.1%. Let's call this 4.0983 at the front end of the curve. Crude isn't hurting this move in WTI and Brent, declining once again by close to 4%. Brent at 72, WTI around 69. That's a cross-asset picture for now. Going into next week, here's the story for you. Before we get there, 10 a.m. Eastern Time, UMich consumer sentiment. Consumer sentiment has been absolutely terrible over the last several months, the last several years. Consumer confidence on Tuesday. Look out for that. More data on Wednesday, ISM and PMIs. On Thursday, it is payrolls Thursday, and I can give you a sneak peek of the estimate in our survey. The median right now is 115. The previous is 172, and these days 115 is seen as pretty good, Danny. A 115 estimate in our survey.
And again, it's the point you've been making. Does that allow the Fed to play for more time, or at least concentrate more on inflation? The numbers have been holding up. Consumer spending has been holding up. We're just talking to Greg Daco about this, but the fear is that you are starting to see real wages start to get eaten into, and so at some point, does that spending not hold up anymore?
Stocks this morning down by 0.5%, on course for a fifth day without gains on the S&P 500. Ulrike Hoffmann-Burchardi writing, fundamentals continue to support risk assets. Equities can move higher. Fed hikes are unlikely, and AI remains the dominant driver of earnings growth. Ulrike joins us now for more. Ulrike, good to see you.
Good to see you, John.
We've got to unpack several themes there. We can save the Federal Reserve. Let's start with the earnings. That's been really supportive of this equity market. You've got 20% earnings growth this year. That decelerates into next year. How are we going to handle that decline?
Well, first of all, 3 drivers of earnings growth for us globally. One is strong government spending. The 4 largest economies in the world are fiscally stimulating. Then we have the AI capex that stands now at 2.5% of US GDP, and the consumer still spending. So in the short and medium term, that's very bullish for equity markets. But as we look further out, fiscal stimulus is going to start to fade, and the consumer may come under more duress. So those are the factors that make us less optimistic about economic growth in the US in the longer term.
Can we pick out the capex story as well? We're starting to see the companies doing all the spending. Their stocks are suffering. I've repeated this all week. Microsoft, Meta, bear markets, not fantastic. Is that going to shape their appetite to spend beyond this year? Will that decelerate?
Possibly. We still think, though, the demand for AI is only going to go up. In our estimates, we predict 25% increase in AI activity by 2030. That requires about 5 times the install base of compute that we had last year. So our estimates are only going higher in volume and in price. Having said that, we are now at the middle game of the AI chess game. And there are going to be winners and losers. The opening game, the first 3.5 years, everybody could be a winner. And I think we are starting to see now the separation from the winners and the losers. And we've seen it in software, of course, early in the year. Software was down over 20% in January. Now, I think the big question, to your point about the Max 7 and the leaders that you mentioned earlier, is the internet also going to be disrupted by AI? If you think about what internet companies do, they take our human attention and they convert it into a transaction. But what happens if agents take over? They are doing our purchases. They are making decisions. That could be a very different future. And I wonder whether that also weighs on the internet companies, not just the CapEx, but also the question of what is the business model of the future going to look like?
How do you find conviction anywhere? I mean, these are huge disruptions, and we won't truly know the answer about just how disruptive the forces are until years to come. So how do you actually trade these ideas when they are changing so quickly?
Selectivity is going to be key. We talked about the index level, but if you just look at the index level, you might actually miss the dispersion that's going on underneath the surface. Active is going to be key in our view. Dynamic, being liquid, will remain key as the world is changing so fast. We have not seen a technology revolution that's been moving as fast. And the reason is because it's self-learning. We have never seen a technology like this. And I think these are the key characteristics. We are still invested in the enabling layer of AI, into the physical parts of the economy. I think you can have much more conviction in the physical world. We are going to have scarcity there. We're certainly seeing it along the whole AI enabling layer. The digital economy, I think, is at risk. And I think that's the opportunity now for active management and positioning in those areas of the AI value chain that are seeing increased scarcity value.
So that's the tech story, and it's linked somewhat to the Fed story because of the price pressure coming from that particular industry group. Now we're starting to have this conversation about hikes, and what really caught my eye in your work is that you think cuts are more likely than hikes. Cuts goes against the grain right now of this moment where a lot of people are starting to think about hikes, not 1, 2, maybe 3 if you're at Bank of America. Why do you believe cuts are more likely than hikes?
I will go there. I just want to make one quick comment. You said technology. We actually think that the sector boundaries are no longer the right ways to think about the equity markets because AI is going to be also a dividing line between winners and losers in technology. So yes, AI is technology, but not all technology is AI. And I think that's what we're going to start to see in the markets already. So now to the Fed cuts. We still think that the next move is going to be a cut further out next year for the reasons that we mentioned earlier, because the economy is going to slow on the margin. You have just mentioned also wage inflation is coming down. So we think the inflationary picture is going to look better next year. And the labor market, in our view, is going to also remain weaker on the margin. We have seen in the technology sector already 140,000 job losses this year. That's likely to accelerate further in the back end of this year. And I wonder whether other forms of knowledge work will also increasingly being replaced. So the labor market, inflation coming down, our base case is still that the next move by the Fed is going to be a cut. I think the one risk case, though, thinking about what the market currently prices, is that goods prices are going to start to spiral higher. Obviously, we've seen this now with the Apple price hikes. We've seen it across all the consumer electronics already. So that's something we are watching. But there are other offsets. So again, our base case is still inflation trending lower, and then the Fed reacting to that lower inflation and potentially weaker labor market.
On that labor market point, because you made the point about AI, I was just thinking because Matt Miller did an interview with Ford, and they talked about that they had to hire a bunch of their veteran workers back because they thought they could lay off more people for the sake of robotics. They're like, oops, we actually need skilled labor. Do you think that that's a mistake that a lot of companies are either currently making or going to make? And how does that shape this labor market discussion?
I think physical AI, we are quite far away from physical AI. I mean, when I say quite far, it's always a question because things are moving very, very rapidly. But right now, it's about knowledge work. And coding, of course, is the best use case for AI. we are seeing there that now AI code is self-checking, self-optimizing. We're getting into the stage, recursive self-improvement. I mean, these are huge drivers, again, of compute demand. Because if code now can self-improve, you could say, wow, actually, is there ever any limit to the amount of compute that you would need? So it's knowledge work. I don't think necessarily, factory floors will be rapidly completely replaced by robotics, but for sure that's going to be a factor over time. Right now, we're seeing also a lot of productivity growth, just being able to do more. So that's another factor that, of course, is very bullish for economic growth.
Ulrike, good to see you. As always, thanks for breaking it down. The more constructive view on this equity market on a day where we're down by 1.3%, at least for the moment, on the Nasdaq. Ulrike Hoffmann-Burchardi of UBS. Just on the labour market, Russ Brownback of BlackRock on the programme earlier mentioning Block and the layoffs there. That felt like it was years ago.
I forgot that even happened.
The end of February,
right.
The layoffs there. Ancient history at this point.
I mean, you have seen some select layoffs in some banking sectors, but the whole idea of people being laid off for the sake of technology, I think because of this pushback, you've had less CEOs talk about it. I mean, Standard Chartered was kind of made this poster child of just how much discontent there has been. So I wonder if these layoffs happen kind of more in quiet going forward, just because of that.
There is a public relations problem in AI right now, and that's for sure. Danny, thanks for this morning.
Thanks for having me.
More Danny Berger coming up. Another 2 hours, Danny.
2 hours.
Open interest just around the corner, taking you towards the opening bell. Going into the cash open, we're negative here by 0.5. On to Monday. Lisa will be back alongside Annmarie. We'll catch up with Ajay Rajadaksha of Barclays, Alicia Levine of BNY. We'll catch up with Amanda Lynham of Goldman Sachs and Jim Karen of Morgan Stanley. From New York City, this is Bloomberg.